Yes, Ms Orr.
The Commission pleases. The next witness is Mr Daniel Huggins.
Mr Huggins, will you come into the witness box, please? Mr Huggins, would you prefer to take an oath or would you wish to make an affirmation?
Affirmation.
Affirmation? Yes, affirm the witness, please.
I solemnly and sincerely
declare and affirm
that the evidence I shall give
will be the truth,
the whole truth,
and nothing but the truth.
Thank you, Mr Huggins. Do sit down. Yes, Ms Orr. Oh, Mr Sherry, sorry.
Commissioner, I think
Yes.
Ms Orr is going to call the witness, but there are a couple of corrections. It might be useful to do those first before the statement is tendered. Or would you prefer that I tender the...
It'll be easier if you take him through his formal details, take him through the corrections and deal with his statement.
Thank you.
Yes.
Mr Huggins, what is your full name?
Daniel James Huggins.
And what is your business address?
11 Harbour Street in Sydney.
And have you made a witness statement in this Royal Commission?
I have.
And have you also received a subpoena to attend and give evidence?
Yes, I have.
I understand. Do you have a copy of the... Sorry, you've made two witness statements, haven't you?
Yes, that's right.
Do you have those in front of you?
Yes, I do.
Are the contents of those statements true and correct, except for a couple of matters I want to draw to your attention?
Yes.
So, with the first witness statement, sir, I understand you wish to make a correction. Why is that?
Incorrectly refers to brokers when it is actually referring to HLS business, which is earlier in the statement.
What's HLS?
Home Lending Solutions, which is a proprietary, not a broking channel.
Thank you. Would you strike out 57B?
Just the sentence at the end.
I think just the exhibit.
The relevant sentence.
Just the
the
bottom
reference
piece,
to the
yes.
exhibit, I mean.
No, the sentence.
So what have you struck out, Mr Huggins?
I've just
in
struck
57B.
Just the bottom part of 57B, which states Exhibit DH12 is a copy of the template letter typically sent by CBA to mortgage brokers prior to being accredited. That is incorrect and has been deleted.
Thank you. Now, with those corrections, I might have asked you this already. Is that statement true and correct?
Yes, it is.
And your other statement is true and correct as well?
Yes, it is.
Thank you, Commissioner. We tender the subpoena and the two statements.
Exhibit number 1.26, I think we're up to, will be summons to Daniel James Huggins. Exhibit 1.27 will be witness statement of Daniel James Huggins, dated 2 March 2018. Exhibit 1.28 will be supplementary witness statement of Daniel James Huggins, dated 7 March 2018. Yes?
Thank you, Commissioner.
Yes, Ms Orr.
Mr Huggins, you supervise the home buying division at CBA nationally, is that right?
Yes, that's right, for all of the yellow branded parts, which is the Commonwealth Bank parts, but not the Bank West parts.
And have you done that since 2014?
Yes, that's correct.
And you describe yourself in the first statement that you made to the Commission as responsible generally for home loan products under the CBA brand. Is that correct?
Yes, that's correct.
And you're familiar with the policies that govern CBA's relationships with brokers and head groups?
Yes, I am.
Do you sit on any committees at CBA?
Yes, I sit on the Risk Committee. I also am the chairman of the Sub-Risk Committee for Home Buying.
I'm sorry, you're going to have to keep your voice up a little, Mr Huggins. The last
Sorry,
committee you
yes,
mentioned.
I sit on the Risk Committee, which is the overall risk committee for the retail bank, and I also sit on a Sub-Risk Committee, which is my home loans Sub-Risk Committee, the two risk committees I sit on.
Yes.
And you said you were chairman of that sub-risk committee, did you?
The Sub-Risk Committee, that's right, yes.
Yes, thank you. And you're also the chairman of Residential Mortgage Group Proprietary Limited?
That's right. So it's a subsidiary within the bank which sole purpose is to provide funding to the Aussie home loans business, but isn't involved with the day-to-day management of Aussie.
So Residential Mortgage Group, or RMG, as you refer to it in your statement,
Yes.
is a separate residential mortgage lending arm of CBA?
That's right. It's a 100% owned subsidiary which is sole purpose is to provide the funding for the Aussie Select product within Aussie.
So for financial reporting purposes, the RBA lending gets consolidated into CBA's RMG lending gets consolidated into CBA's financial reports?
That's right. It gets
Yes.
consolidated into the RBS business. That's right.
And you've said, I think, that the home loan products that RMG offers are not CBA branded products,
That's right. They're Aussie Select products. That's right.
but they are CBA funded home loans.
That's correct. Yes.
And they are what I think we've referred to already in the hearings. They are a white label home loan product.
That's right. So they use the Aussie brand. They don't use the CBA brand at all. So they're not linked to the CBA brand. They're linked only to the Aussie brand.
And why don't they use the CBA brand?
Well, CBA has its own products that are offered through that channel. So it's to have multiple brands in market, and Aussie has its own offering, which is a different product. It's not as fully featured. People who take the Aussie product, for example, don't have access to the CBA branch network or to the call centre. So they're sort of separate brands and they have separate offerings.
Mm-hmm. So you've said that the particular white label product that RMG offers is called Aussie Select.
That's right.
And so Aussie Select is made available to consumers through two mortgage broking entities, is that right?
That's right. It's made through Aussie Home Loans. It's also made through an aggregator called NMB, National Mortgage Brokers. That used to be owned by Aussie, but was recently divested from Aussie. So it still continues to offer that product because it was set up when it was a part of Aussie.
So I want to make sure I understand this. The Aussie Select Home Loan is made available through Aussie Home Loans, which is a wholly owned CBA subsidiary. It's provided by Residential Mortgage Group, which is another wholly owned CBA subsidiary, and it's funded by CBA.
Correct.
So I want to put to you that that's all a bit confusing for the customer, is it not, Mr Huggins?
Well, it's clear to the customer that Residential Mortgage Group is funding the home loans and that it's a Aussie product. It's also very clear in all of our statements that Aussie is a 100% owned subsidiary of the group.
Is it clear to the consumer that it's ultimately CBA funding the home loan?
Well, yes, I think it's clear to the consumer that Aussie Home Loans is owned by CBA, and therefore if you were taking an Aussie branded product that would be associated with the CBA.
But Aussie offers home loans from lenders other than CBA.
That's right.
Right. And what's the reason for having Residential Mortgage Group as a separate entity, separate corporate entity from CBA?
I think it's just cleaner from a funding perspective to keep that asset, to keep the funding vehicle separate. The other reason I believe it was set up, it was before I was at the group when it was set up, but we use different systems, so we utilise different systems, so it allows those systems to also be used as a separate company that provides the systems that are used by RMG to provide that product, because we're unable to put an Aussie product onto the CBA systems.
Mr. Huggins, you're dropping your voice again. I'm sorry.
Sorry.
Just, yes, I think either move a bit closer, or if I can just recall my age, Mr. Huggins, that's enough.
My apologies.
And mine, Your
So, Mr. Huggins, home lending is a very significant part of CBA's business. Would you agree with that?
Yes,
And CBA markets itself as Australia's biggest home lender.
that's right.
And as at the 31st of December last year, you tell us in your statement that CBA's total lending was $586 billion. That's paragraph 15 of your statement, Mr. Huggins.
Correct, that's all lending,
Yes.
not home lending, just all lending.
Yes, and of that total lending of $586 billion, $374 billion, or 64%, was home lending.
That's correct.
Yes.
Was the RBS home lending, that's right. Yep, the retail banks home lending.
Yes. Sorry, there's two acronyms in play here that are similar.
Sorry. Yeah.
RBS is the CBA Retail Banking Service, so that's CBA.
Yes.
And RMG is the Residential Mortgage Group corporate entity that we've been
That's
discussing.
right, and the 374, the RMG part will be included in that.
Yes, I see.
But what's not included in that is any lending that Bank West is doing. So Bank West is another entity of the group, which would be included in that $586 billion of total lending, but wouldn't be in the yellow brand. Sort of yellow brand is the CBA brand, orange brand is the Bank West brand, and this is yellow. The 374 is the yellow brand plus the RMG part.
What sort of percentage would we get to if we added the orange brand?
That's a good question. Probably about 80%, I would think, of sort of 80 plus percent, I would think.
Mm-hmm. You explain in your statement that CBA provides loans through two different channels.
That's right, yes.
And that's a proprietary distribution channel and a third-party distribution channel.
That's correct.
And the proprietary distribution channel involves loans that are offered directly to customers through a CBA lender or an authorised representative of CBA. Is that correct?
That's correct, yes.
And the third-party distribution channel is loans being offered to customers indirectly through mortgage brokers.
That's right, yes.
And as at the 31st of December last year, 41% of CBA's home loan portfolio came through the work of mortgage brokers.
That's right.
Yes. So almost half, a very significant proportion of CBA's lending.
So this is the portfolio. So 41% of the portfolio, the back book was with brokers, but the flow, which is the new business which is being written, in the first half of this year was about 36%. So the flow is at the moment slightly lower than the portfolio, and this number is the portfolio.
So the flow has reduced, you said, in the first part of this year?
The flow's been reducing over the last couple of years, yes. As a proportion. So the proportions have been changing.
Yes.
And we've been writing a slightly lower proportion through our broker network, the third-party network, and slightly more through our proprietary channels.
And has that been an objective of CBA, to reduce the proportion of home loans coming through the mortgage broking channel and increase the proportion of loans coming through the proprietary channel?
Yeah, we've certainly been investing heavily in our proprietary channels to try and increase the proportion that have been coming through.
Well, the loans that come to you through your proprietary channel are more profitable. They have a higher margin for CBA. Do you agree with that?
Less, they are more profitable, yes, but it's less the margin and more the other costs which are associated with. There aren't the same commission costs associated with a proprietary loan versus a third-party loan. And we don't load into those costs when we're making that. However, the full costs of the branch network, so we've got approximately 1,000 branches, and we don't take all of those costs and load them into the cost of the home loan. We sort of consider, well, those are fixed costs which exist there, and in that case, we're able to utilise that network to then for our lenders.
But do you allocate any part of branch network costs to the lending side?
That analysis is occasionally done, but when I think about the loans, I'm more thinking about it on a marginal cost basis rather than a fully loaded cost basis is how I tend to run the business.
Do you agree with my proposition that CBA has an objective of increasing sales through its proprietary channel and reducing sales through its mortgage broking channels, switching those proportions?
I think there's a difference between the sales and the proportion. We certainly have an objective to increase the proportion of loans that are coming through our proprietary channels, but I still want to sustain a strong broking channel and therefore the sort of dollar sales. I'm comfortable with where they are now, but I'd like to move the proportions. So if I could hold the current level of sales in my broking channel and then grow in the proprietary channel, that would be, that would be part of the objective.
Mortgage brokers are commonly used by consumers these days, so the mortgage broking channel will always remain, will it not?
Yes, I mean, it's certainly, I think it's used by around 56% of funded loans now, so it's a substantial part of the market, and there's a very good service proposition which is offered by brokers which consumers like. So yes, I would expect that it's a part of the market which is likely to be sustained.
So CBA deals with mortgage brokers through mortgage aggregators and mortgage franchisors, is that correct?
That's right. I would collectively refer to those as head groups, but yes, that's right.
Could you explain to the Commission what a mortgage aggregator is?
So an aggregator is someone that brings together a lot of brokers into sort of a platform and then aggregates that business together and then sends it off to us. So we would deal with 26 aggregators and head groups rather than having to deal with the 13,500 brokers who are accredited with us. We're able to deal with a smaller number of aggregators, and those aggregators then provide services to those brokers to assist those brokers. So they provide the customer relationship management systems, and a range of other services to those brokers.
And what's the difference between a mortgage aggregator and a mortgage franchisor?
So a franchisor will have the brokers operating under their brand and under their ACL, their Australian Credit Licence. Where an aggregator, the brokers under an aggregator would have their own brands and may also have their own ACLs, their own Australian Credit Licences.
And Aussie Home Loans is a mortgage franchisor?
That's correct.
Right. So CBA enters into contracts with these head groups, with these mortgage aggregators and mortgage franchisors, is that right?
Yes, that's right.
And you gave a figure of 26 before. Is that the figure of head groups, both mortgage aggregators and mortgage franchisors that CBA currently has contractual arrangements with?
That's right.
And Aussie Home Loans is one of those head groups?
Yes, it is.
Are there other CBA subsidiaries amongst those head groups?
Yes, there are subsidiaries. There's other entities that we have a relationship with. I think that's in my statement here. FinConnect, which is a wholly owned subsidiary and also uses the eChoice brand, and then Mortgage Choice, which isn't a subsidiary but which CBA has a shareholding, and that's in 34 AB and now D. So
CBA owns a number of the head groups that it deals with, either wholly or partially?
3 of them, yes.
Thank you. You've exhibited to your statement a document which is a template of CBA's contractual arrangements with a head group.
Yes.
I want to turn to that document and ask you some questions about it.
Sure.
It's your Exhibit DH4, CBA 001 0028 0344. I'm sorry, I might have left a 0 off the first numbers, 0001 0028 0344. So this is a contract between CBA and a head group. It's a template for a contract from the 17th of August last year. Is this still the form of template that's used in the contractual arrangements between CBA and head groups?
Yes, this is the standard template.
Thank you. Could we turn to 0347 of that document? So these are the categories of service that the head group is to provide to CBA, is that right?
Yes, that's right.
And we see there from the first one that the head group at 2.1 is to personally interview the potential customer.
Yes, that's right.
But to understand that, we need to go to some definitional clauses, because it's not the aggregator or the franchisor that interviews the customer, is it? It's a broker who works for the aggregator or the franchisor.
That's right. The aggregator or the franchisor, so the head group can have a nominee which will provide these services. It could also be provided by a direct employee, so there's both ways.
Well, I'll take you to it if you need to see it, but there's a reference later in the document to what a personal interview generally means at page 50 of the document, and it generally means a face-to-face interview between the applicants and the nominee for the purpose of obtaining and recording information to complete and submit an application. You see that?
Yes.
And the nominee is also described in the contract as any person nominated by the intermediary, that's the
right.
head group, as a nominee, employee or agent. So that's generally the mortgage broker. Is
Yes.
that right?
Yes, that's right.
Okay. Now that we haven't moved to that page, it's all right. I wanted to take you back to page 4, the page we were on. There is a requirement in clause 2.4a for the head group to provide to CBA all relevant information in support of the customer's application for the products in the format required by CBA or as agreed between us from time to time, including evidence and verification of employment, income and assets. Is that correct?
Yes, that's right. Yes, that's right.
So the verification of the customer's employment, income and assets is outsourced to the broker?
No, not the verification. So they are required to provide that information to us, and then we will verify and validate that information from those primary source documents.
So why the reference to verification here in the contract with the head group?
Well, we would expect that a broker is looking at those documents and therefore in the application, ensuring that the information they're providing to us is accurate, but I'm not outsourcing the verification of that to brokers. I then, once I receive that information, then do that work myself.
Yes. Are head groups or brokers agents of CBA?
I'm not sure what the legal definition of an agent is, but they're certainly, representing the brand as an accredited broker.
Would you describe them as an agent of CBA?
That's not terminology I would normally use in the business. I would sort of use a broker or an accredited broker rather than an agent. I guess I sort of see an agent in my language as sort of more being aligned with an employee, and a broker isn't an employee.
It might not be language that you use, but it's language used in this document, isn't it, Mr. Huggins? Could I take you to 0367 of this document? You can see the doc ID numbers on your
Yes, I can.
copy? Yes.
Yeah.
Now, could I ask you to look at, this is in the schedule to the agreement. I'd like you to read clause 1.14 there. In respect of each application for a product, you must ensure completion and, where necessary, collection by you as our agent in accordance with our procedures of customer identification, tax file number disclosure, privacy protection of information forms, and any bank account opening application. So the head group is told that they are CBA's agent?
Yes. Yeah, in this document, yes.
Okay.
As I mentioned, that's not sort of the language I'd commonly use in the business, but yes, I see it's written here.
Are head groups required to promote CBA products?
Not to promote them. I mean, they are encouraged, a broker where it meets the needs and objectives of a customer to put the CBA product to that customer where it's most appropriate for the customer.
Could I ask you to look at page 30?
And your view of when it's appropriate, might be that it's often appropriate. Is that right?
Yes, I mean, I'd argue we have the best product in the market, so I would think it probably is, but, you know.
Well, rather than dance around the point, Mr. Huggins, the fact is you expect these people to push CBA product, don't you?
I don't expect them to push the product where they know that product is not appropriate for the customer, and there may be instances where our products are not appropriate for that customer, but where they assess that the product is appropriate for the customer, then I would hope that they offer the CBA product to them. But there will certainly be circumstances where a CBA product is not appropriate for a customer.
Well, this head group contract expressly tells the head group that they are to promote your products. I'd like to show you 370. And if we could have 369 and 370 displayed at the same time, that would be helpful. And you'll then see, Mr. Huggins, that these clauses are part of Part 2, which imposes general obligations. We'll just need to see the first part, general obligations on the head group. You must. And then if we look at 2.10, you must promote our reputation and our products.
Mm-hmm.
Do you see that there?
Yes.
Yes. Could I turn to Part 3 of this document at 349? And it might be useful again to have 349 and 350 displayed at the same time. This is the part of the agreement with the head group that deals with the commissions that CBA will pay to them.
Yes, that's correct.
Yes. And do you see from these pages that the head group receives both an upfront commission and a trailing commission for any home loans that are submitted through the head group that CBA approves?
Yes.
So trailing commissions carry through for the life of the loan, is that right?
Yes, that's correct.
And they're calculated by reference to the net balance of the home loan account at the end of each month?
That's correct.
So the larger the loan, the larger the trailing commission,
That's correct, yes.
and the longer the period of the loan, the longer the period over which the trailing commission will extend.
That's correct.
And head groups pass on the commission that is paid to them by CBA, or at least part of that commission, to their brokers?
That's correct. That's my understanding, yes.
Yes. And
There may be some franchisors which pay a salary and therefore don't pass on the commission, but generally people would pass on the commissions.
so the general arrangement is that CBA pays the aggregator or the franchisor upfront and trailing commissions, and a proportion of that is passed on to the broker.
That's generally the case, yes.
And CBA has recognised, has it not, that upfront and trailing commissions for mortgage brokers can lead to poor customer outcomes.
Yes, I think we have acknowledged that there is a conflict in the commission structure, as I think has been recognised by others as well, in that the commission structure is linked to the size of the loan, and therefore there is a conflict in that the upfront commission, that the larger the loan, the larger the upfront commission, and then, as you mentioned before, the longer a loan takes to pay off and the larger it is, then the larger the trailing commission, and that can lead to a conflict. Well, there is a conflict between the customer and the broker.
Because it's in the mortgage broker's interests to get the largest loan approved possible to extend over the longest period of time for the customer to repay it.
That's how they would maximise their income, yes.
These sorts of problems have been acknowledged by your CEO?
Yes.
Yes.
Yep.
Can I show you a document which is a letter from your CEO, Mr Huggins, which is at CBA, it's not attached to your statement, CBA 0001 0038 0929. I think you will have been shown
Yes,
this
yes.
document.
My legal team showed
Mr.
me this
Huggins.
document, yes.
Yes, you've read through it.
Yes, I have.
And you can see that it's a letter dated the 10th of February 2017. If we could just pull up the second page so we can see the author. And perhaps we could have both those pages on the screen at once. So this is a letter from Mr. Narev, your CEO, to Mr. Stephen Sedgwick, the independent reviewer for the Retail Banking Remuneration Review on the 10th of February 2017.
Yes, that's correct.
Could we look at paragraph 3 on the second page? And we see there, and I should say this is a submission, or it annexes a submission made by CBA to Mr. Sedgwick as part of his review.
Yes, I believe it was a confidential submission to Mr. Sedgwick made by Mr. Narev.
Yes. What we see in paragraph 3 of this document is that Mr. Narev says to Mr. Sedgwick, under the heading, the need for greater consistency in mortgage sales remuneration, we agree with the reviewer's observations that while brokers provide a service that many potential mortgagees value, the use of loan size linked with upfront and trailing commissions for third parties can potentially lead to poor customer outcomes. Mortgages also sit outside the financial advice framework, even though buying a home and taking out a mortgage is one of the most important financial decisions an Australian consumer will make. We would support elevated controls and measures on incentives related to mortgages that are consistent with their importance and the nature of the guidance that is provided. For example, the de-linking of incentives from the value of the loan across the industry and the potential extension of regulations such as future of financial advice to mortgages in retail banking. So that reflects CBA's position on these matters.
Yes, it certainly reflected Mr. Narev's views to Mr. Sedgwick. Yes, that's right.
Yes, and that therefore is CBA's position on these matters.
That's right, yes. I mean,
Yes.
yes.
Well, you seem hesitant about that. Is there some hesitation about this now being CBA's position?
I think this has been CVA's position. I think the way in which you would achieve this it obviously needs consideration. So that's why there's a hesitation in that moving to this, for example, delinking of incentives, you need to be considered about how you would achieve that, and there's a range of things to consider in that.
Why don't I take you, Mr. Huggins, to the issues paper submission that was annexed to this letter sent by Mr. Narev to Mr. Sedgwick, where there is a discussion of how this might be done. That document is CBA 0001 00380931. Yes, there we go. You've seen this document as well, Mr. Huggins?
Yes.
And this document was sent by Mr. Narev with that letter to Mr. Sedgwick in February last year.
Yes, that's right. Yes.
And can we turn to 944 within this document? Under the heading Issues Specific to Remuneration of Third Parties. And you see that there's a submission here which is directed to answering a question, which is there sufficient evidence to support a case for banks discontinuing the practice of volume-based commissions to third parties in respect of new and increased mortgages? And the first point that's made there is that, as the reviewer identifies, the use of upfront and trailing commissions linked to volume can potentially lead to poor customer outcomes. Our analysis of loans applied for through the proprietary versus broker channel shows that, firstly, broker loans are reliably associated with higher leverage. Secondly, even for customers with an identical estimate of ex-ante risk, loans through the broker channel have higher leverage. Thirdly, loans written through the broker channel have a higher incidence of interest-only repayments, meaning customers pay down their loans more slowly. Now, that's important, is it not? Because we've talked about the life of the loan being directly related to the amount of the commission that the broker receives.
Yes, that's right.
Paper goes on to note that broker loans have higher total debt to income levels, higher loan to value ratios, and higher incurred interest costs compared to proprietary. Do you agree with these points so far?
Yes, these were the
Yes.
findings that were made
And
at the time.
over time, higher leverage means broker customers have an increased likelihood of falling into arrears, pay down their loans more slowly, and on average pay more in interest than proprietary customers. You agree with that?
Yes, that's correct.
Yes. Now, the paper goes on to note that these findings are consistent with the hypothesis that differences in remuneration between the channels are driving different customer outcomes and lend some support to the case for discontinuing the practice of volume-based commissions for third parties. Do you agree with that proposition?
Yes.
Then the paper talks about multiple considerations that need to be looked at, and these are the sorts of things I think you were referring
That's right,
to.
and that's why I hesitated in that, there are a range of considerations that you'd need to make.
And the considerations that are referred to here are that any changes will need to be made uniformly across the industry and across both proprietary and broker channels to eliminate bias and avoid significant market disruption. Now, is this, in the words of the Commissioner to another witness yesterday, a first mover problem?
Yes, there's two problems. One, there's a first mover problem in that the person who moved first would likely lose a lot of volume. The second problem is you create a conflict if one person or half of the people move and the other half don't, because then a broker's in a position where if the loan was best suited to one person who where do they put the loan? So you're creating a conflict and you've got a first mover problem.
I thought that was called a market and competition.
Yeah, well, it's certainly competition. That's right.
Yeah.
The paper goes on to note that a move to a flat fee payment would enable brokers to be agnostic towards loan size and leverage. However, consideration is needed on the payment amount, on how to link the fixed payment to an underlying security rather than a product, i.e. to avoid unintended incentives to split loans into multiple fixed or variable products, and on appropriate clawback periods to disincentivise the churning of loans to maximise broker income. Now, I'll come to this concept of churn later. But finally here we see that the paper records that a move to flat fee could also consider the removal of trail commissions, which can encourage brokers to suggest slower pay down strategies, e.g. interest only, that maximise broker trail commission income. So you agree with these propositions that are articulated in this document that Mr Narev sent to Mr Sedgwick last year?
Yes,
In February of last year.
that's right.
We're here now in March of 2018. CBA has known all of these things for some time, but CBA has not stopped paying volume-based commissions to brokers.
That's right.
Has CBA taken any steps towards ceasing its practice of paying volume-based commissions to brokers?
No, we haven't.
And the incentives for head groups have not been therefore de-linked from the value of the loan in the way Mr Narev referred to in the letter.
No, that's correct.
So why not go ahead and do what your CEO has told Mr Sedgwick should occur?
Well, I think as Mr Narev mentions in his note that these changes would need to be done on a uniform basis. Otherwise, what is a very important business to the Commonwealth Bank could be substantially damaged. In addition to that, there are a range of other considerations which would need to be made to move a commission structure. One of those is that, and is articulated in here, that you don't create additional conflicts in what you move to. Second, in moving a commission structure, you need to make sure that there are some segments of the population who currently utilise brokers that may not be able to continue to access the services of brokers if you were to change the commission structure. For example, a first home buyer who benefits from the services but requires more work. And also you need to make sure that the broking industry remains viable in a move to any new commission structure model.
So
Why do you need to ensure the broking industry remains viable? Why does CBA need to be concerned about that?
Because our customers, our research shows that our customers value it. Our research shows that there's about 20% of our customer base, so our existing customer base prior to getting mortgages, who would only go to the broker channel, and therefore it remains an important channel for CBA to continue to be able to provide services to customers given that's the case. So there is a segment of customers who, based on our research, would only use a broker, and therefore that's the only way to get access to them is through the broker.
Whether or not they're told that CBA is altering the arrangements and you will no longer, if you deal through a broker, end up paying trail commissions for the life of your loan.
Sorry.
You think this problem is not soluble by telling the customer what change you make and why you make it?
No, I don't think it's solved with that. The mortgage market is a competitive market, and so for the majority of customers that will go to a broker, there'll be some customers certainly where the CBA product is definitely the best product. They'll only ever choose CBA, but there's a large portion of customers whose needs can be met by a range of other providers in the market, and therefore, if we were to move unilaterally, then I think you would see those customers in a competitive market whose needs can be met by other providers move to those providers, and therefore it would have a very material impact on the business.
Well, the balance that then has to be looked at is the balance between risk of poor customer outcome, threat to profit. Is there any other element that would need to be taken into account in that assessment?
As long as the risk of poor customer outcome also included, the fact that this is a service that customers like. It's often it's a very good service often, and you'd need to make sure that customers were getting that. It's a big decision for customers. Many in the broking industry are providing good advice and help to customers in what's a big decision. So you just need to consider some of those things as well.
You've raised a lot of difficulties with making this move, Mr. Huggins. What I want to put to you is that those difficulties are all surmountable and that CBA hasn't started the process of dealing with any of those difficulties. Do you agree with that?
I'm not sure I would suggest that the difficulties are surmountable if CBA would act alone.
Could we go back to the part of the head agreement that deals with the commissions, Mr. Huggins? So back to I'll find the full number. It's your exhibit DH5. Let's have the doc ID again.
DH4.
I'm sorry.
I'm still on the commissions page.
Exhibit 4, 0001 0028 0344. I apologise.
444.
44. So back to your Exhibit 4 in your statement.
Yep.
And back to the pages that we were dealing with in
350.
relation to commissions, which are 0349 and 0350.
Yep.
We had both of those pages on the screen before.
Yes.
So do we see from these two pages, Mr. Huggins, that the head group has what's called a flexible commission plan,
Yes, that's right.
in the sense that there are 3 commission models that the head group can choose from.
That's right. They can choose 3 different intermediary models in 3.1.
So we see the 3 different models in clause 3.1.
Yep.
They can select a commission plan which applies to all nominees.
Yes.
They can have each nominee select their own commission plan.
Yep.
Or they can select the nominees who can select their own commission plan and also select a commission plan for their nominees.
So they can do 1
That's a
or
hybrid.
2 or both.
A hybrid,
Yeah.
yes.
Yeah.
The decision to have a flexible commission plan that allows a head group to choose between these different commission structures was made after CBA conducted research on different commission structures in 2014.
That's correct. Yep.
Yes. Could I show you another document that's not annexed to your statement, Mr Huggins? It's CBA 0001 0031 0057. You've seen this document before, Mr Huggins?
Yes, I've seen it. It was conducted just before I became the General Manager for Home Loans. Yep.
Yes. So it's September 2014. It's a piece of research done by ACA Research for CBA on identifying the optimal mortgage broker commission structure.
That's right.
And this research led to the flexi commission plan that we see in the head group.
Yeah, that's
agreement.
right. The context to the research was we were replacing the commission structure. The commission system. So we were investing and rebuilding the commission system. And as part of that rebuild, we had the opportunity to offer, rather than just one commission structure, we were able to offer more or build the capability to do that. So this research was informing whether that was something we should do or not.
Could I ask you to turn to 0063 to see the methodology that was used in this research? Do you see there was a quantitative online methodology used, a survey that went for approximately 10 minutes. Participants were sourced from a list of CBA active brokers across Australia, with a total of 489 mortgage brokers taking part, and respondents were incentivised for their participation. And the surveys were completed in that period in September 2014. Now, CBA, we see, specified that the results should be representative of its broker base by tier and state. A representative spread was achieved in the final sample, so weighting was not necessary. And we see further down the page an explanation of CBA's broker tiers, and I want to ask you about each of those. So the first one listed there is the diamond tier of mortgage brokers. They are mortgage brokers who write at least $15 million and or at least 75 loans in settlement volume, plus they achieve any 3 of the 5 quality metrics. Does CBA still have this system of diamond, gold, silver and bronze brokers?
So we've recently announced that we are changing that, and we're removing, we have removed the requirement for there to be this volume threshold. So the segmentation's been simplified down to 2 tiers, essential and elite, and you would have in that new tiering system quality metrics and then a series of complementary metrics, but you'd be able to get into that elite tier, which is where we offer our best service offering without necessarily hitting a volume target. So you could get there without the volume, and then everyone in the essential level, as is the case with all of these others, they're offered a sort of very good baseline level of service, but then the best service is in that. So this was in place at the time, and has been for the couple of years post this. In practice, when you look at the diamond brokers, many of them weren't actually meeting these volume targets. But either way, we've recently announced that we're going to simplify that, remove the volume target, and we're progressively rolling that out now.
So you say you've recently announced that change. When
Yes.
was that change announced?
It's been announced at our PD days, which were happening in sort of January and February, so over the last couple of months, based on work that's been going on into during 2017.
It's not something you've referred to in your statement?
I think I have referred to it in my statement in the back end where it was other changes which were being proposed. Well, that may be the accreditation scheme. So, no, we may not have. I don't think we were asked about the segmentation scheme. So we've also changed the accreditation scheme, which I'm happy to talk to. But I think in my statement, I was just asked about the accreditation policy. So we addressed the changes that we've been made to the accreditation, new accreditation policies and ongoing accreditation. But I don't think I was asked about segmentation. So I know it wasn't in the statement on segmentation.
So that change has been announced, you said, at PD days in January and February.
Yes.
Has there been a transition yet?
The
or-
transition's happening now, yes.
The transition's
Yeah.
happening, okay.
Yeah.
So there are still some brokers who understand where they sit in the segments by reference to diamond, gold, silver and bronze?
I mean, yes, that would be a familiar thing with brokers. It's been around for a long time, so it would be familiar to them. But we recognised that there's a conflict created in this structure, in that someone, because it's volume based, it means that someone that's right on the threshold of being a diamond broker, and being a diamond broker is valuable because you get the extra service, can create a conflict. So that's why we've made the change.
So what are the benefits, or what were the benefits of being a diamond broker as opposed to a bronze broker?
So the benefits were primarily around service, and I think this research shows later that the turnaround time, that service level is really important to brokers. So we offer and because it's so important to all brokers, we offer a sort of uniformly good proposition to brokers. Even a bronze broker, should be getting a 2 to 4 day turnaround. But we offer an even better level of service for that diamond broker. So everyone gets a good level of service, but if you're a diamond broker, then you're going to get a faster turnaround. I think there's some other benefits as well around access to people and sort of advice on loan structuring and some of those things. But the predominant benefit, and if you spoke to people in the industry, I think they would say the predominant benefit is that turnaround time, which people really value. So, we have the good baseline, and then a diamond broker gets a elevated level.
So do I understand that to mean that CBA processes the applications submitted by diamond brokers faster than it processes the applications submitted by gold, silver or bronze brokers?
Yeah, that's correct.
And that's in recognition of the volume of home loan applications that are being submitted by diamond brokers as opposed to gold, silver or bronze?
Yeah, when this system was in place, that's right. It was volume linked, and you got better service for being volume linked, and that's why we've changed it.
To encourage brokers to submit and recommend to customers CBA loans over loans from other lenders?
No, it was in recognition of the fact that, everybody got a good level of service, but I can only offer the very best service, which is more expensive. I've only got a limited amount of resource. I've got 13,500 brokers, so I can't offer a one-day turnaround to 13,500 brokers. I have to choose who I'm going to offer the best service to, and at this stage, the way of segmenting it was by volume, in recognition of those brokers who were the largest writers of business. But you tended to see that, and part of the reason we changed it, you tended to see that the people who had lots and lots of volume would end up in these tiers, where someone who had a lot lower volume, just because they may have been in a smaller town, wouldn't end up in these tiers. So we've changed it to both acknowledge the conflict and also to try and get some of those people who are writing great loans, delivering fantastic service to customers, but would never have been able to get into one of these tiers. We'd like them to be able to get access to that best service.
How long was this segmentation of brokers in place before CBA, as you put it, acknowledged the conflict that it created?
I don't know exactly how long. It was certainly in place as long as I was running the business. It was in place when I started. In June 2015, I took over responsibility. When I became the EGM, I took over responsibility for the broking business. It was in place then. It had obviously been in place when this. So you know, certainly several years. And when I came into the business, I started discussing it with Sam Bohr, who was the head of the business, and we've changed it accordingly.
So at this time, in 2014, when this research was being done, and until relatively recently, brokers were segmented in this way and rewarded according to the volume of loans that they submitted in terms of the timeliness of the turnaround by CBA. And we see the different volume targets for each of the levels within this document. Down to the bottom, a bronze broker is someone who wrote less than $5 million in settlement volume. I should just ask, these figures relate to what period?
I'd have to check. I think it's annually.
Annually.
Yeah.
And below a bronze broker who wrote less than $5 million in settlement volume was a bronze non-performing broker.
Mm-hmm.
And that was someone who settled less than one loan in the year to date.
Yeah, that's right. So they were inactive brokers who aren't running business.
Who, I'm sorry?
Who aren't sort of having any activity with CBA.
And what were the consequences of being regarded by CBA as a bronze non-performing broker?
My understanding is there was really no consequence over this time period, up until recently when
Yes.
when we decided in 2017 to de-accredit some of those brokers based on quite a lot of thinking that I'd done, and you know a desire to improve the average quality of the accredited broker with CBA and improve customer outcomes.
We'll come to that in some detail, Mr. Huggins, but before I leave the discussion of these categorisations of brokers, I assume a customer who goes to a broker has no way of knowing whether the broker they're dealing with is a diamond, gold, silver, bronze or bronze non-performing broker.
I think that's generally right from my understanding. I have seen occasionally, you know, a certificate on the wall that says I'm a diamond broker with CBA, but generally, I think that'd be right.
Okay. And could I just ask you to look at 0067? Before I leave this segmentation, we see there a chart explaining the broker classification, and we see that diamond, gold and silver tiers are referred to as high volume and high tier brokers. Is that right?
Yes, in this, the way they'd broken it up here, yes, that's right.
And then the bronze tier is high volume and low tier, and the low volume tier is down the bottom there.
Yes, that's right. Okay,
so high volume, high tier, high volume, low tier, and low volume brokers was another way of looking at this categorisation of brokers.
For this research, yes, that's how they broke it up. You know, generally in the business, we would have over this time period just seen it as diamond, gold, silver, rather than the high volume, high tier. But in this research, that's how they cut it up.
So the reason this document has references to diamond, gold, silver, bronze, as we saw from the last page, is that there was a desire to make this research representative across the breadth of CBA's brokers. Do you recall seeing a reference to that effect? So there were 489 brokers surveyed.
Mm-hmm.
Some of them wanted to move to a flexible commission plan, some did not. Is that right?
Yes, that was the outcome of the research, that it was suggested that people would want a flexible plan. It's interesting what happened when we put the plan in place.
Well, could we talk about what was reported in the research first?
Sure, no problem. Yep.
First. So if we turn to 0075, this slide summarises some reasons that were expressed for not wanting to choose a commission plan, saying lender choice should be about client needs. And do you see the reference there on the first column to the second gold broker expressing the view that it takes away from what we do, and it would be hard not to be biased if we were always changing and picking commission structures? That was one of the views expressed.
Yes, that's right.
And if we turn to the following page, 7.6, we see that this is a slide about the reasons for wanting or not wanting a number of commission remuneration plans to choose from. These are verbatim responses. And on the right-hand side, the reasons given for not wanting to select a commission remuneration plan include, from a bronze broker, because it adds more work to my process and might unduly influence me as to which lender to pick. And from a diamond broker towards the bottom, it gets too complicated and could influence choice of lender. And down the very bottom, from a silver broker, it will create conflict of interest. So these were views that were expressed to CBA in this research about the potential move to a flexible commission plan.
Yes, yeah, that's right. Yeah, I mean, I think it almost refers back to what we were saying a second ago about if you were to make a substantial move and sort of really move your commission structure away from others in the market, per the question before, there's a view that could actually influence people's decisions.
So this document records a way of dealing with these concerns expressed by brokers in this research at 0105. You see the last major dot point. CBA will need to educate brokers about the program, clearly demonstrating that the flexible structure will not increase commissions, just deliver greater control over business income. A third, 30% of those who don't want to select commission plans, responded that lender choice should be more about client needs, expressing concerns that flexible commission structures would unduly influence lender choice. This was particularly evident among the high-value, low-tier segment, who appear to be especially client-centric in their decision-making. So what do you understand that reference to mean? Shouldn't all brokers be client-centric in their decision-making?
Yes, they should be.
So you had close to a third of those polled in this survey telling you that they didn't want to select commission plans because they thought it would unduly influence lender choice and their job should be about client needs, but CBA went ahead and went with a flexible commission structure. Is that right?
I don't think it was a third. I think it was 30% of the people who didn't want to.
I'm sorry, you're right.
Yes, we went ahead, but I mean the research influenced the way that it was set up. So when you look at Plan B, there's not a substantial difference between the different plans, about 5 basis points, and then there's a difference in the way the trail commission comes together. So it certainly was taken into consideration when it was designed.
I think you wanted to say something earlier, Mr. Huggins, about what you saw once the flexible commission structure was in place.
Yes, we spent money to develop the system to allow multiple plans, and I think it's less than 80 people are on Plan B out of 13,500 brokers. So, whatever that is, 99.995 or whatever it is, people are on the standard plan, Plan A. So despite the fact the research showed that people would like this and that they would like more flexibility, people have not moved away from the standard plan, which is common in the market and has evolved over time as the plan that brokers seem to like, and this would show that even when you offer them a choice, they're not going to move away from it.
Could you remind us what the standard plan is?
So the standard plan is 65 basis points upfront commission, 15 basis points of trailing commission for the first 3 years, and then it increases to 20 basis points from the fourth year. So it's that plan.
Yes. Commissioner, I'll tender that document.
That's CBA 0001 0031 0057 ACA research identifying optimal mortgage broker commission structure, and that will be exhibit 1.29.
Can we go back to the head group agreement again,
Sure.
Mr Huggins?
Yep.
This time to 0353.
Sure.
And perhaps again we could have this page and the page following brought up. Now, this relates to a different topic in your contracts with head groups. It's not about commissions, it's about commission allowances. Is that right?
It is, but it's linked to the commission. So if we look at the previous page, which we were just looking at, on 350, you can see the standard plan has a base upfront commission of 50 basis points, plus you can have some commission allowances, which are then on 353. So we say 50 basis points, and then on top of that you can get 15 basis points worth of allowances, which then makes up the 65 basis points
I see.
that I talked about before. But practically we haven't been applying these allowances since, my understanding from the team is sort of late 2014. They were essentially competed away.
What do you mean by that, Mr Huggins?
We were applying them through 2014, and when you see the research that you were referring to previously, what you see in that research in some of the back pages is that brokers say that part of the reason that the CBA at that time was good, encouraging conversion, was because of the commission structure we had in place, because we were applying these. So if you didn't have a high, if the quality wasn't high enough, or your conversion didn't meet these thresholds, then you wouldn't get the upfront commission assessed quarterly. But we got, my understanding, as I mentioned, I wasn't in the business. In preparing for this, was discussing with my team, the research and this, and we were getting a lot of complaints about the fact that, we were doing this and that others in the market weren't, and therefore we weren't competitive in the upfront commission amounts, and so we decided to discontinue the application of this. So although it is in the contract, we haven't been applying it for the last couple of years.
I see.
So everyone's practically been getting the 65 basis points of commission up front, as I mentioned
without
before.
needing to meet the criteria in
That's right.
this table.
Yep,
So
that's right.
they don't have to meet the submission quality criteria or the conversion criteria. They just get that as part of the commission.
That's right, not
I
as part
see.
of the commission, and then, and I'm sure we'll talk about it later, as we've sort of changed the new accreditation program. We've tried to bring some of these features into the accreditation program for new brokers, as well as for ongoing accreditation, to try and capture this and raise the standards.
So within this document, we see that what it says about commission allowances in 4.3 is that if the total loan amount, which is minus any money that the customer owes on an existing CBA home loan, so that's referred to as new money, is less than $5 million in a particular month, then CBA didn't have to pay the commission allowance for that month. Is that not a clause that's enforced any longer?
No, not that I'm aware of.
Right. But it remains in these contracts.
It's in the contracts, yeah. Yep.
And is capable, therefore, of being enforced, but in practice you say is not.
That's right. That's right. At every quarter, we make a decision on whether it's applied or not, and practically it's not being applied.
And if the average monthly settlement for a head group in respect of CBA products falls below $5 million, CBA also is entitled under this document to terminate its arrangement with the head group. Do you agree with that? I can show you the clause if that assists, Mr Huggins.
Might be worth just looking at the clause, but
3.14 at 379. Yep,
makes sense. Yes.
So another volume requirement there, a monthly volume requirement that has to be met to not risk termination of the agreement by CBA.
Yes, that's right. That right exists in the contract. I'm not aware in my time of us having applied that, but the right exists.
And I'm not
Well,
sure.
not having applied it because the occasion hadn't arisen.
I'm not sure. I'm not sure whether there are any of our head groups that that currently write less than $5 million. So I'm not sure that. Yeah.
Could we move to another part of this document, which is part 6, and that deals with something called the Connect Referral Program. This is on at 355. I'll just ask you while that's coming up on the screen, if you wouldn't mind, Mr. Huggins, and I think again, we'll just have that page. That's the only page that deals with this part. Could you explain to us what the Connect Referral Program is?
Yeah. So there may be other products, as is here, that the customer would like, that they have a need for. They might have a need for risk insurance or general insurance, and that product is sold by, or that need is met by our proprietary channel. So the broker is unable to provide any advice on those products. They're not trained, so we don't allow them to deal with those products. But they will be paid a commission should they refer a customer to us for one of these products, and that customer subsequently takes out one of those products.
So it's
Speak of customer needs, these are needs that the customer may or may not be aware of, aren't they, Mr. Huggins?
When they're first having the conversation, yes, that's right. That need may be discovered in the process of
They might
the
be
loan
persuaded
application.
they need something.
They could be by the broker, but then it comes into our proprietary systems, and our system there is that we have a needs-based assessment, and a financial health check to make sure that product is appropriate for their needs.
I just want to suggest to you that the expression customer needs is a euphemism.
I mean, our processes around how we are discussing this with customers is discussing with customers what their needs and objectives are, and making sure that the product is appropriate for those needs and objectives. So, I can't comment to the conversation that's happening with the broker, which we're not in, but certainly when that comes into our branch network, the approach there is very robust.
So the upshot of this, Mr. Huggins, is that if the broker suggests to the customer that they acquire another CBA product, such as a mortgage loan insurance product, and the customer ultimately signs up to that product, there is a monetary payment, another form of commission that's paid to the broker. Paid to the head group. Is that right?
Yes, that's
paid
correct.
to the head group, which we assume then again a proportion of which would go to the broker.
Yes, that's right.
Yes. Could we turn to part 7 of this document at 357? So perhaps we could have 356 and 357 on the screen together. I'd just like to ask you about 356 and 357. Now, clause 7.2 on 357, this part is about when commission's paid. We see on the first page that total upfront commission is payable fortnightly, trail commission monthly, a referral services commission monthly. Then 7.2, we will review the arrangement at least 12 monthly, and in addition to our other rights, have the right to alter the commission structure if your average monthly settlements for the previous 12 months in respect of the products, which are the CBA products, fall below $5 million.
Yes, that's right.
So this is another risk for the head group and the brokers if their volume to CBA is inadequate.
Yes, that's right.
Okay. Then part 10 of this document at 363, Mr Huggins, deals with another monetary payment, a productivity and partnership program bonus.
Yes.
So this is a bonus paid to head groups, and to get this bonus, the head group needs to meet certain performance targets. Is that right?
Yes, this program's since been changed in this.
Sorry, you're dropping your voice again, Mr Huggins. This program's since been changed,
this program has been changed so that the any volume-based, aligned with what we did. We've gone through and tried to remove these conflicts. So, this in here sort of reflects a volume payment. That's a volume-related payment, which was the case. I think last year it was also linked to settlements. It's been changed this year, so there isn't a settlements component to it. The base structure under the program is linked to the compliance and training programs of the organisation, and then there's a series of quality metrics which would link to other payments under the program, but it's been disconnected from settlement volumes.
I want to be clear about this, Mr Huggins, because I did ask you earlier if this was still the template for the contracts between CBA and head groups, and I understood you to answer that it was, but we're now saying that there are multiple clauses in this contract that you say don't operate in the way the clause suggests.
That's right. We've made a number of changes, to the way we've been running the business since 2015 when I took it over, and we were trying to improve the business on the way through, and these contracts are in the process of being updated, but they haven't been yet. So this remains the standard template.
And all of these volume requirements remain in the contracts that are being signed up by head groups with you.
These contracts have been in place for quite some time, so yes, they still remain in force.
Yes.
But as I mentioned, we are progressively going through and removing these types of things where as you identify, you read it, and there's a conflict there on volume. So we are going through and removing those conflicts.
The concept of one party to a contract removing provisions intrigues me, Mr Huggins. How's that work? You make a contract with someone else, it contains certain provisions, you now say that, you can remove the provision?
No, I mean, in this case, it's an optional payment. We don't have to pay this. It says we may pay it, and we've gone back and said, look, the basis upon which we're going to pay these payments, we're not going to link it to the settlement amounts that we were linking it to, because we think it improves the program. And people are, they cannot take they are entitled not to say, well, I'm going to opt out of it, but we haven't seen that.
The final part of this document, I want to ask you some questions about, Mr Huggins, relates to the clawback of commissions in part 11.
Yes.
0364.
Yes.
Now, I want to summarise how I understand these clauses to work, and you can tell me if I interpreted them correctly or not. As I read them, what these clauses do is create a situation where if a customer repays their loan back within the first 12 months, CBA claws back the entirety of the commission that's paid to the head group.
That's right, if the loan was refinanced or repaid. So
yes, I was going to come to refinancing. It's the same situation. So if it's paid back or refinanced within 12 months, the commission paid to the head group is taken back by CBA.
That's correct.
And if that happens within the first 18 months of the loan, then CBA claws back half of the upfront commission.
That's correct, yeah.
So it is disadvantageous to brokers for customers to repay their loans quickly.
It's disadvantageous for a broker to have a customer repay the entire loan.
Yes.
In the first 12 or 18 months.
And it's also disadvantageous to the broker if their customer refinances their loan within that period.
That's right. It would be surprising why a customer would need to refinance the loan within the first 12 months if you've actually had a good conversation. If you've done your job properly and understood the needs of the customer properly, you should be able to put them in a product which they can be in for at least 18 months.
What if the customer wants a better rate on their product and becomes aware that they can get a better rate within the first 12 or 18 months?
Yeah, I mean, they're not locked in to this, so they can refinance, and the broker in doing that would then get another upfront commission from whoever they went with, and that would offset obviously the amount that we clawed back from them. But you don't want the incentive where the broker is able to get more and more and more commission the more and more they were refinancing a loan within the first 18 months. It's we wouldn't suggest that would be a great customer outcome either. So the way this works is in the first 18 months or first 12 months they would get a clawback, but we would expect that if that was the right thing for the customer because there was a better rate somewhere else, then the broker wouldn't necessarily benefit from that, but because the broker the broker would then have to would be able to offset the clawback, but the customer would benefit from the interest rate.
All right.
We don't charge any other break fees or deferred establishment fees or those sorts of things.
We can leave that document now. And can I ask you a few further questions about broker remuneration and incentives, because you deal with this in your statement. You refer to 5 different types of remuneration that CBA pays to head groups: upfront commissions, trail commissions, connect referral program payments, funding under the CBA Partner Quality Assurance Scheme, and non-financial benefits that are paid directly to brokers, such as tickets to hospitality or sporting events and charity golf days.
Yes.
Now, we've already spoken about upfront and trail commissions and the Connect referral program. Can I ask you about the non-financial benefits? You tell us in your statement that since December 2017, this is paragraph 44, if it assists Mr. Huggins.
Thank you.
Since December 2017, the non-financial benefits have been limited to an amount of $350 per person per event. So prior to that time, there was no limitation on the number or value of non-financial benefits that CBA could give directly to brokers.
We didn't have a formal policy in place for that, no.
And the Partner Quality Assurance Scheme, that's a scheme by which CBA pays money to head groups to assist with training, development and compliance, is that right?
Yeah, so that's the PPP program, which you were referring to in the contract before, is now called the PQAS scheme, so the Partner Quality Assurance Scheme. So when I said before that PPP program
That bonus.
had been, it had been replaced. This is what it's been replaced with, this Partner Quality Assurance Scheme.
Yes, I see. And when you say in your statement that those payments are to assist with training, development and compliance, in 42 of your statement, what do you mean by that?
So we'll provide funding for a conference where there's training. We may pay a base amount of funding where we're asking for certain compliance activities, or maybe funding direct compliance activities to benefit us. So we're trying to partner with head groups here to try and raise the compliance standards, and we're prepared to fund that with the head groups to help drive better outcomes in terms of compliance for the Commonwealth Bank.
And so when it was the previous version of this scheme, the amount of money was connected with the volume and value of settlements. That's right?
Yeah, that's right. So we would set a target on settlements at the start of the year, typically based on what that head group had written in the previous year, and then the payment would be linked to that, and that's the bit that's been removed.
But now you've moved to quality metrics, is that right, as
Right.
the way to look at this?
Yeah, that's right. So there's a base payment which is made, which ensures that the head group gets some certainty and they can then invest in compliance functions or a training conference. And then there's a variable component, and that variable component is linked into quality metrics. So we're measuring things like minimum living, adherence to minimum living expenses, application quality. So there's a series of sort of 5 key metrics that we're reviewing, and those quality metrics are running through the whole business now in terms of how we think about ongoing accreditation of brokers, the head group standards. Our own relationship managers are also moving towards those quality measures.
Can I take you to one of the exhibits of your statement that deals with these quality metrics, which is DH7,
Yep.
CBA 050700210225.
Yep.
So this is a document that relates to this new scheme that's replaced bonus, the volume-related bonus.
That's right, yep.
Now we've got the PQAS scheme, which is a recent development, is that right?
Yes, that's right.
Late last year?
Yes, late last year. I think it was put in place for FY18, which is sort of started halfway through last year.
And on the final page of this document, which is 0228, we see the 6 quality metrics.
Yes.
Now, I want to suggest to you that one of them is still related to volume. Number 6, utilisation.
Yeah.
The percentage of brokers who submitted at least one product application over the last 28 days.
Yeah, that's
so
right.
there is a volume component still within your quality metrics.
Yeah, it's being removed in the next year coming. So we announced it
A
in...
lot that's been removed from these
Well,
documents, Mr. Huggins.
Well, I mean, this document was the current document, and it is this year's document. But as I mentioned, we're doing a huge amount of work to make sure that we are identifying these, where they exist, and I'm taking proactive action to get rid of them where they exist. So this was in place, and as you mentioned, it was volume linked. It was in place to try and get at. We've got a lot of inactive brokers, which I'm sure we'll come to on the de-accreditation, and we observe that those brokers have lower quality and really aren't meeting customer expectations. So it was in there for that. As we're now moving, and in this next half, we're moving to the new way in which we'll assess ongoing accreditation of brokers. This isn't necessary anymore because we've got our new way of assessing ongoing accreditation, and I can get assurance around the quality of brokers who are accredited with CBA, and I don't need to rely on these measures, which as you rightfully suggest, can create some conflict. The new way in which we'll monitor accreditation will de-link that, and someone who doesn't write any volume with me can continue to retain their accreditation, but I'll get some assurance activity and some training done with those people. So it is there now. I don't want to suggest it has not yet been removed. It is there for this current period, but it is being removed for next year's program.
I see. All right. Now, I'm going to move to a new topic, Mr. Huggins, which is about the disclosure to the customer of the remuneration that's paid by CBA. You were asked in your statement to explain how a customer is informed of the remuneration that a residential mortgage broker receives, and in response you referred to 2 documents in your statement, and the first of those is CBA's Broker Loan Consumer Credit Contract Schedule, and that's part of CBA's standard loan documentation. And that document is Exhibit DH8 to your statement, CBA 050700030448.
Yes, that's correct.
Now, the Consumer Credit Contract Schedule starts at 460 in this document.
Yes, that's correct.
It's a 6-page document that's a schedule.
Yes.
And if we turn to the 5th page of that document, which is 464, we see a reference in item J that you rely on as one of the ways that the customer is told about the remuneration that's paid by way of commission. Is that right?
Yes, that's right.
Yes. So in item J, we see the following: commission we pay in relation to the loan contract to, and there'll be
It'll be the
a head group.
It'll be the head group's
head
name.
group referred to there. And then there's a reference to amount, and that amount is listed in this document as not ascertainable. Is that right?
Yes, that's right.
And you explain in your statement that it is always recorded as not ascertainable because the total amount of the commission is not known at the time of preparing the loan contract and will depend on factors such as the time it takes to pay the loan, and you say also the extent to which the customer acquires other CBA products.
Yes, that's correct.
So firstly, what does it matter if the customer acquires other CBA products
There
to
may-
the
There may be a
commission?
connect payment that's payable to the broker.
Okay, so it might be higher because of the connect referral payment,
That's right.
but all the consumer is told is the identity of the head group and that there is an amount that is not ascertainable that will be paid to that head group. Is that right?
Yes, that's right. We, as you mentioned, we're unable to calculate the amount that will be. We're unable to accurately calculate the amount that will be payable over the full life of the loan because the loan can pay down on a different profile, and therefore we disclose not ascertainable. We we rely on the broker who is required under NCCP to disclose how much they are being paid both to the broker and to the head group. We also don't know here what the arrangement is between the head group and the broker. So that they may have their own variable
But
relationships.
this isn't about
No, that's
the
right.
broker. This is about the head group and what CBA pays to the head group.
That's right.
And it tells the consumer nothing.
No, that's right.
Nothing at all. Why can't you disclose the upfront commission?
We could. We haven't done that to date because we've seen this as the full amount as what should be put here.
You see it as the full amount, but the full amount isn't given, nor is any part of the amount. Why can't you disclose the rate at which the trailing commission will be applied?
We could disclose that. I'd have to understand from my team what it takes to do that. But there's but we could do that. We're not doing it here, but we could do it.
It shouldn't take much, should it, Mr. Huggins, to tell the customer that there is an upfront commission of X dollars and there will be a trailing commission paid at a rate of X percent on the balance that is outstanding at the end of every month. And there is also an amount that's being paid because there's been a referral of another CBA product under the Connect referral program.
No, that's fair.
And that amount under the Connect referral program is a set amount. It's a set dollar figure that attaches to whatever the product was that was referred. So why can't those things be included in these documents for the benefit of the customer?
They could be included. I'd need to understand the systems changes and that, but I'm not. They could be changed. I'm not.
Why
They could be
aren't
included. They haven't been included because it was taken on the basis of we can't provide the customer with an accurate dollar amount of that commission, and as you suggest, improvements can be made to that
It'd be
in terms of
unfair to
disclosure.
describe the proposition as being economical with the truth.
I think it was not our intention in setting it up this way. We were, our belief was we couldn't accurately calculate the dollar amount, and that's what we put in here. But I certainly acknowledge that there are other ways to provide more transparency to the customers about what's being paid. We haven't done that to date, and it's certainly something I'll take away.
There's a second document that you refer to as well in this area, and that's the Credit Assessment Summary document. That's your Exhibit DH9 0507 0004 1654. This is a very new document, isn't it, Mr. Huggins?
Yes, that's right. We put this out in December, early December this year, and it continues
Last year?
Sorry,
Yes.
we haven't got to December this year, so
Yes.
last year, sorry.
Yes.
2017.
So you introduced this document in December last year,
Mm-hmm.
but prior to that, the document we've just referred to was the only document that the customer got that told them anything about the commission.
That's right, yes.
So now, from December 2017, this document goes to a group of people that you describe in your statement at paragraph 48 as personal customers. What do you mean by that?
So we, at the moment, it's being extended. I've approved the funding to extend it, but at the moment it's going to individuals rather than businesses or trusts. So we sometimes lend to trusts, and we're not yet providing this document to those, but that's being worked on, and in the next several months it will be closed. But we've started with the majority of loans, which is individuals.
Yes.
But I wanted to be clear in my statement that it wasn't covering the full universe,
Yes, thank you.
although we're extending it.
Yes. And at what stage in the loan process is this document provided to the customer?
So this document is provided when we produce that document pack. So when we produce the credit contract, we provide this document to customers which summarises all of the information we've received and made our decision on, to make sure the customer is signing that information as an accurate record. It would typically not be as long as this. This is sort of a sample, so it would typically not be as long with as many forms of income or expenses. But that's the point. When the customer has got the credit contract, they're about to sign, they get this document just to confirm that the information that's been used in approving their loan is still accurate. And also it allows us in here to talk about the needs and objectives and why a customer is doing what they're doing, to just get a final check of have you given us the right information? Is the information that's been provided to us appropriate? And for brokers, that's important. This is the one way in which we get a sort of check back to that customer of the information.
The bit the customer has to sign is at 1658 of the document.
Yes, that's right.
There's a declaration there made by the customer.
Yes.
And if we could perhaps move into the the sixth dot point and highlight that. By signing this document from December 2017, the customer acknowledges that the bank may pay a broker or other intermediary acting in relation to this inquiry for finance, commission or other benefits in connection with the inquiry, and that any commission is disclosed in the Consumer Credit Contract Schedule. So let's pause there for a minute. The customer's acknowledging that CBA may pay a broker a commission, and the commission is disclosed in the document we've just referred to, which does not in fact disclose the commission. Is that right?
Yes, it discloses that it's not ascertainable, that's right.
Yes. So this doesn't advance things for the customer. I want to put to you, Mr. Huggins.
From a disclosure perspective of the commissions?
Yes.
Yeah, I think that's right. It's another check. I think it certainly advances things materially in terms of our other systems and controls.
No,
But not
what
related to
I'm
brokers.
asking you about is the customer understanding what commission is going to be paid by CBA to the head group. This acknowledgement, this part of this new document tells them no more than the last document. In fact, it might make it even less clear for them, because now we're talking about the potential for a payment to the broker, not an actual payment to the broker.
Yes, that's right. I mean, this document is provided to sort of all customers. So yeah.
Yes. And then the acknowledgement below that, the customer acknowledges that as a broker or other intermediary may provide services to me or us, it is possible that a conflict of interest will arise. We consent to a broker or other intermediary acting in this way. Now, can I pause there? Acting in what way? What is the customer acknowledging there?
That the broker or intermediary is acting as providing services to them.
I see. Nothing to do with the possibility that a conflict of interest will arise, just an acknowledgement that a broker or intermediary may provide services to them.
That's right. I mean, we're asking the customer to acknowledge that there is a possible conflict that could arise, but
I see.
I don't think we are asking, it's certainly, it's not the way it's intended to be written, that we're asking the customer to consent that the broker would apply a conflict of interest.
Well, what are you asking the customer to consent to there? They are consenting to a broker or other intermediary acting in this way. What way?
Well, providing the services to them, and that there is a conflict of interest, as we've discussed before, in the remuneration structure. So, we are asking the customer to consent to the broker, acting and providing the services to them.
But how does the customer reading this know about the conflict of interest that you and I have been discussing? How is the customer directed to that? They're told that it's possible that a conflict of interest will arise and that they consent to the broker or intermediary acting in this way. What are they meant to understand and acknowledge when they sign this that's not apparent from those two sentences?
Look, it could be clearer. I think again, it's a new document which we're trying to raise the standards and help, make people aware that, look, there could be a conflict here. As you start forensically examining it, then there's possibly a way for it to be improved, and I'll certainly go back to my team and do that. But as I say, we're trying to help people be aware of the conflicts and raise the standards and remove them. But yeah, as you suggest, I'll certainly go back to my team and suggest that we make some changes which make it clearer about very specifically what the conflicts are. But when I asked the team to put this document in place, we thought it was a good first step.
The customer goes on to acknowledge in this paragraph that they consent to the bank disclosing to a broker or other intermediary the fate of any applications submitted and providing the broker or intermediary with a copy of the bank's approval terms and conditions. If the bank pays a broker or other intermediary a trailing commission, we also consent to the bank disclosing the information about the loan to them on an ongoing basis. So that's all about the customer consenting to the bank providing information to the broker that they need for the purpose of the calculation of their commission, isn't it?
Yes, that's right.
But do you agree that this is likely to confuse a customer? Because again, we're talking about if the bank pays a broker a trailing commission, the customer is not being told in this document or in the first document that you referred to that a trailing commission is in fact being paid.
Look, as I acknowledge it, it can certainly be clearer. And I'll go back to the team and do that. I mean, it certainly was our intent was to try and raise some of the conflicts, and it can be clearer.
You speak of some of the conflicts. I understand you to accept that a part of the conflict is relating commission to value of the loan. Is that right?
Yes.
What other cause of conflict or source of conflict is there other than relating size of commission to value of loan?
And that's the conflict I'm getting at here. It's the referral. I mean,
to identify a premise that is presently suppressed but needs to be exposed, the amount of work the bank has to do as lender, does that amount of work vary according to the value of the loan?
No, it doesn't. It doesn't typically. The only reason I hesitate is sometimes a higher value loan can have a more complex loan structure. So if you're dealing with like for like loans, then no, the amount of work doesn't tend to vary.
Does the work of the broker vary according to the value of the loan? Again,
With the same
making
caveat.
the like for like qualification that you just made.
No, I wouldn't think so.
That is to say, if a flat fee were payable, regardless of value, would there remain a conflict of the kind that you have identified?
Not of the kind we've identified.
Would there be any other kind of conflict that would emerge if a flat fee were, a flat fee commission were to be paid?
Yeah. Yes, there are potentially some others. If there's a bank paid flat fee, you just need to be careful in designing anything like that you didn't, if you were paying, if it was a single flat fee, then you'd remove any potential for conflict between, well, if I pay one flat fee for, one loan type or one other loan type, then you'd remove that. You'd also have to make sure that you didn't create a conflict which encouraged churn of the loan very, very quickly. And then, as we discussed briefly before, you just want to make sure that in any sort of structure like that customers were still able to access brokers whose service they value. But that's not a conflict as much as just a consideration.
I said to you earlier that the poles that are to be compared are commercial outcome, that is to say profit, and consumer outcome. Is that right?
Yes.
Now, in observing those to be the poles, it does not follow that one pole is to be preferred necessarily over the other. Bank is a commercial enterprise. Commercial enterprises are there to make profits. I think sometimes we lose sight of that fact. But what I invite your attention to is the need to make an explicit choice and a thought-out choice between those two poles. Would you accept that?
Yes.
Some point, perhaps in answer to Mr. Sherry, it may be that you would wish to expand on why one choice has been made rather than the other. Because it's all very well to highlight two poles. There's a lot of ground between the two poles.
There is.
The way in which you balance them is not simply a binary answer.
No, that's absolutely right.
What I'm inviting attention to is that you need to front up to the question. Now, as I say, Mr. Sherry may or may not, as he's advised, choose to take that up with you. Ms. Orr may or may not, as she's advised, take that up with you.
For now, Mr. Huggins, I want to continue with the conflicts of interest topic and show you one more document before moving on to some questions about accreditation of brokers within the CBA. Could I ask that you be shown CBA 0001 00330741? Is this a document you've seen before, Mr. Huggins?
Yes, it is.
A mortgage broker head group review work program.
Yes.
And we see from subsequent pages of the document in the footer that it's dated the 15th of May 2017.
Yes.
And we've been speaking about conflicts. I'd like to show you page 743 of this document, and while that's coming up, could you explain what this document is and what the mortgage broker head group review is?
So we put in place, this is effectively our audit of the head group. So this is the work program which we go through when we audit a head group, which was recently put into place to assess both their compliance with their contracts, but also, and as you're on the page here, also to understand their compliance programs and how good those programs are, given that our relationship is with the head group rather than direct with the broker.
So there's recognition in this document of problems that you see in the compliance framework for head groups. Do we see the area compliance framework on the first page there? And the third row down relates to conflicts of interest. And this document's reflective of much of what you have been saying, Mr. Huggins. It's an acknowledgement on the part of CBA that there is a conflict of interest problem with head groups, and we see there that what this document tells us is that governance systems and processes are in place to identify and assess conflicts, and controls are in place to manage and or disclose conflicts to consumers. Let's stop there. Can you explain what those systems, processes and controls are?
Well, this is the document that provides the work plan of what we're looking for when we go to the broker. So it kind of,
I see.
So what we want to be doing here is going into the head group,
Yes.
and understanding, there is the conflict of interest. So what are the head groups?
Yes.
Governance systems and processes
Yes,
that
I
are
see.
there, and we'll ask them to show those to us, and we'll send people in to look at them and make sure that we think that they're suitable and appropriate.
So there's a recognition of conflicts of interest as a problem, and this document is clearly placing that on the agenda for the reviews of head groups conducted by CBA, and particular conflicts are given here as examples. One of them is brokers are not focusing on achieving sales targets over the interests of the client. So that's the risk identified by CBA, that brokers are doing the opposite. They're focusing on achieving sales targets, not focusing on the interests of the client.
Yeah, that's right. I mean, that's
Yes.
a way of talking about the same conflict we've been talking about.
Thank you. I tender that document.
Mortgage broker head group review, working party CBA 001 0033 0741 will be exhibit 1.30.
Commissioner, I was proposing to move to a different topic now that deals with broker accreditation.
Yes.
I'm not sure if the Commission would like a brief break at any point this
Probably
morning.
desirable, I think, given that I've got everybody working forced March hours, that it's about 20 to 12. I'll come back at quarter to 12. Adjourn till quarter to 12.
Mr Huggins, I said I was going to move to the accreditation of brokers by CBA. Mortgage brokers who submit CBA home loans must be accredited by CBA,
That's correct.
and they also have to be accredited by their head group.
That's right.
And to be accredited by CBA, they need to first hold an Australian credit licence or an ACL.
As a broker,
Yes.
no, they don't need to hold their own ACL.
Sorry, I'll put it to you this way. They can either hold their own ACL, or they can be an employee of someone who holds an ACL, or an authorised credit representative of an ACL. I'm sorry.
No, that's correct, yes.
Yes, so
Yep.
one of those things
One
has
of those
to
three,
apply.
yeah. That's right, yeah.
And what generally is the case is...
It's split. Generally, it's either I've got my own ACL, or I'm a credit rep.
Yes. And in your statement, you summarise the processes by which an individual broker is accredited by CBA.
Yes.
And one of those steps is completing a form called an authority to act. Is that right?
Yes, that's right. They can either complete that form or they can complete it online.
Yes, but
Yeah.
that form needs to be completed as part of the accreditation process.
That's right.
And you've annexed that form to your witness statement at DH11. It's
Yes.
CBA 0001 0027 4036.
Yep.
Now, can I start by asking you, Mr Huggins, why this form is called an authority to act?
It refers to the fact the broker is acting, as an authorised, as a accredited broker, and therefore will, act on behalf of CBA in the process of selling the home loan.
I see. So the mortgage broker is acting on behalf of CBA in submitting home loans to CBA for the customer.
That's right.
There's no contractual arrangement between CBA and the broker, is that right?
No, that's right. The contractual arrangement is with the head group, and then the broker must be accredited with us, but it's through the head group.
Mm-hmm. And why is accreditation of a broker by CBA necessary before a broker can submit a home loan application to CBA?
We want to ensure that that broker meets our standards and is able to meet the customer's expectations that they have when they see a CBA logo on a window or on a website.
Could we look at page 3 of the Authority to Act document, so 4038, and there is a section there, section 5, nominee/broker acknowledgement and agreement. Do you see that?
I do.
So the broker has to sign this acknowledgement, acknowledging that to maintain accreditation with CBA, they need to submit a minimum of 4 home loan applications and settle a minimum of 3 home loans in a 6-month period. Do you see that reference there in the second last dot point?
Yes, I see that
Mr.
reference.
Huggins?
Yes.
And that's something that by signing this document, they acknowledge they have to do to maintain their accreditation.
That's right.
And it's a requirement for them to obtain accreditation in the first place, that they agree to do that.
That's right. Yes. I mean, this is not something that we have been enforcing, but it's in this document.
I see. So it's another part of your documents that, I'm not sure how to put it, that is meaningless?
Well, I think over time, as we've tried to, raise the standards and these types of, so we're not applying any consequences to this.
So despite asking brokers to sign up, acknowledging that this is a volume requirement that they need to meet to maintain their accreditation, you say that that's not the situation, that CBA is not in fact requiring brokers to do that.
We are not enforcing this, albeit that it's...
I see. I see. So there's a difference there.
We haven't traditionally been enforcing this. That's right.
I'm sorry, Mr. Huggins, you're dropping your voice. Repeat your last answer.
So we haven't systematically been enforcing this requirement.
Well, the word systematically carries a lot of baggage,
Yeah.
Mr. Huggins.
I mean,
You're going to have to unpack it for me at some point.
I don't want to suggest that we've never enforced it, because we're about to talk about some of the de-accreditation rules. But I have 4,000 brokers who are accredited with me out of the 13,500 who are inactive or have very low volume. And therefore, I don't want to sit here and suggest to the Commission that I'm applying something like this when I've got 4,000 brokers who are inactive or writing very low volume.
Mr. Huggins, at some point I'm going to have to write a report about this. I'm going to have to record what I find about these sorts of things, I think. What you're telling me is there are bits of the document to which you are not giving effect.
Yes.
Or perhaps not giving effect systematically. What am I to make of it all, Mr. Huggins? We've heard on a number of occasions this morning, this bit of the document we're not enforcing, that bit of the document we're not enforcing. What am I meant to make of all this? Do I find any of it in your statement?
Well, in the statement we've been talking about how we're in the process of changing the way in which we are accrediting our brokers, maintaining the accreditation of brokers, monitoring the head group. So we're just in a position of we've we're doing the work and have been doing the work of improving and therefore, some of these documents haven't caught up with the work that we're doing. And as I mentioned, some of it, has been work that's happened last year and is really being announced in the last several months. So the standard documentation which we've generated hasn't caught up to the fact that we've been doing all of this work to raise the new accreditation standards, the ongoing accreditation standards, and we've been explicitly focused on trying to move to monitoring quality and taking out some of these volume parts.
Can I just see if I can capture a couple of points that, at least at the moment, I think I get from what you've told me? First, you told me just after the break that the Broker Act as an accredited broker on behalf of CBA in the process of selling a home loan.
Yes.
In your eyes, at least, the broker is the face of CBA. Is
Yes.
that right?
Yes.
And he's acting on behalf of CBA.
Yes.
And in connection with that, you have been moving to a point where you expect all brokers, if they are to be accredited, must sell a certain amount of CBA product during certain periods.
No, we're not moving to that part. What we have moved to and announced we're moving to is that, in line with the broker being the face of the CBA, I believe that is coming with the expectations from the customer that broker is going to be able to have a good conversation about CBA products and processes and be able to meet that customer expectation. Where a broker doesn't write loans, doesn't have any activity, my ability to monitor how that broker is meeting that expectation falls apart. I can't work out whether someone's got a good quality application if I'm not seeing any volume from any application. So what we have moved to, and we've recently announced, is that for accredited brokers, people who are already accredited with us, we'll monitor them based on the quality metrics, which, an example we saw before, a range of quality metrics. If you're not writing volume with us, then you're going to need to do some more training, and we'll ask the broker to do a training on the regulatory environment and our products to give myself assurance that they can meet that customer expectation. Now, that is an evolution from the de-accreditation where in the start of 2017 I made the decision based on my belief that customers had an expectation of brokers, that I couldn't monitor it, and then some other work we did which showed that my hypothesis that they would be lower quality showed true, that I would de-accredit brokers who were very inactive with us, and that resulted in us in obviously quite a substantial reaction from the industry. We then consulted and worked with the industry at length to come up with what we've now put in place. So we have intentionally now delinked the ongoing accreditation requirement from volume, but I expect brokers to still be able to meet the customer expectation that they can have a good conversation with customers about CBA products and processes. So if I'm not seeing any activity which allows me to monitor them normally, then I'll require some additional training to create the assurance that they can have that conversation with customers.
I won't delay you further, Mr. Huggins. I'll go back and read the transcript with great care. I should say to you that at least at the moment, I have some difficulty understanding what you've just told me. That's my fault, not your fault. I need to go back and reread the transcript, but I must confess I don't have clear in my head exactly what you have just tried to convey to me. As I say, my fault, not yours.
Do you want me to try again? I'm happy to
Well, Mr. Sherry will have his chance later, perhaps.
There are a number of themes to that answer that you just gave, Mr. Huggins, that I want to ask you some questions
Sure.
about when we come to the de-accreditation program
Sure.
that you just referred to. But just before we move to that program, could I just direct your attention to some additional parts of the acknowledgement that the broker signs up to in this document? The acknowledgements include an acknowledgement that the broker will comply with terms and conditions, this is the top part, and the Commonwealth Bank's Mortgage Broker Code of Conduct. You see that?
Yes.
And could I show you the Mortgage Broker Code of Conduct, which is Exhibit DH13, CBA 050700041646. Is this the current version of the Mortgage Broker Code of Conduct?
Yes.
And I direct your attention to the first paragraph. We are committed to the highest standards of ethical behaviour at all times. The Commonwealth Bank's Code of Conduct clarifies the standards of behaviour that are expected of our accredited mortgage brokers in the performance of their duties. Now, what I want to ask you is what duties you're referring to, or CBA is referring to there. They are duties to CBA?
Yes, their duties in the provision of the mortgage.
To CBA?
To the CBO, and their duties to the customer as well.
Thank you. And then number 5 in the Code of Conduct, I will adhere to the bank's instructions, processes and policies and will not in any way exceed my authority. Now, can I ask you again what that is a reference to? What is the authority given by CBA to brokers?
Well, the broker's able to submit the application, but they're not allowed to approve the application.
Okay.
So it'd be the authority to submit.
Okay. All right. And then I think we can leave that document and move to the topic that I think you've perhaps been ready to move to for some time now, Mr. Huggins, which is the revocation or de-accreditation of large numbers of brokers by CBA in 2017. Can we start this way? I want to understand approximately how many CBA accredited brokers there were at the start of 2017.
Approximately, start of 2017, approximately 12,500, 13,000 brokers.
Mm-hmm. And early in 2017, CBA conducted a de-accreditation of brokers program. Is that right?
That's right. We de-accredited 710 brokers.
I'm sorry?
We de-accredited 700 and we sent a de-accreditation notice to 710 brokers.
710 brokers, thank you. And prior to this de-accreditation program, you tell us in your statement that the accreditation of brokers was revoked on 3 grounds only. This is paragraph 71 of your statement, Mr. Huggins. Accreditation could be revoked where CBA had identified that the broker had engaged in inappropriate activity, such as by submitting false or fraudulent information in a home loan application. Also, if the head group identified that the broker had engaged in inappropriate activity of that kind, or if the broker or the head group informed CBA that the broker was resigning or otherwise leaving the industry.
That's right.
So prior to the de-accreditation program, those were the circumstances that led to revocation or de-accreditation.
That's right.
But the de-accreditation program early last year involved revocation on different grounds that you've already made reference to. Brokers had their accreditation revoked because they were inactive or less active than other CBA accredited brokers. Is that right?
Yes, that's right.
Now, by that, I understand they were not submitting applications for CBA home loans or not submitting, in CBA's eyes, enough applications for home loans.
It was less about enough and more that they were not submitting those applications, and that meant that I and the team were unable to monitor any sort of quality, and then we did some work around that which affirmed the view that the quality out of that broader group of brokers who were not writing volume was lower than that of others.
Well, I want to ask you about that, but can I put to you first the proposition that these inactive brokers in CBA's eyes were perhaps just submitting applications for home loans to other lenders? They were recommending to their customers that they take out home loans with other banks, not CBA.
Sure, they could have been doing that. Again, there's a customer expectation with CBA accreditation that a broker is going to be able to credibly talk about CBA products and processes and policies, and whilst someone may still be sending loans to someone else in the business, someone else in the market, another lender, they still have to meet that customer expectation that a customer has when they see that that person is CBA accredited, and indeed when the CBA brand is used in that broker's business or in their advertising.
Well, why do you assume, Mr. Huggins, that brokers who are not regularly submitting home loan applications to CBA are not credibly talking about CBA's products? Why do you assume that? Why could they not be credibly talking about CBA's products but recommending other products to consumers or having customers choose other products?
I mean, that's at an individual broker level, you identify the challenge that I have, and that the way I would monitor a broker for their ability to have a great quality conversation is by how many times does it go back and forth between my credit officers. How often is a broker putting in a loan with low expenses? What's the conversion rate of that loan? So those are the typical metrics that you would use for a broker. And when there is no loan or there's no activity, those metrics don't work because I don't have any activity by which I can assess the quality of that broker, and I don't get any transparency around the loans clearly they're sending to other lenders. Mm-hmm. So then on the basis of that, I asked my team to look at the group of brokers, look at all of the brokers where there is an activity, and therefore see whether the hypothesis that would be lower quality proves true, and the results of that work showed that there was a lower conversion rate, that there were more errors, that there was higher arrears, and that seemed to affirm the view that brokers who have less activity don't understand the CBA processes and policies as well as brokers who are writing more loans, and therefore they can't be meeting they couldn't be meeting the customer expectation of being able to credibly talk about the CBA products and policies. And from there I made the decision that for the least active ones we would move to de-accreditation, which we spoke about before.
Well, I want to put to you that you didn't de-accredit the 710 brokers because of their conversion rates, their errors or their arrears. You de-accredited them because they were not recommending enough CBA home loans to their customers.
That's not right. That is not why we de-accredited those brokers. We de-accredited those brokers to raise the standards of the average broker that is accredited with the CBA, and I did not believe that brokers who were not writing any volume with CBA were going to meet the customer expectation that someone who has a conversation with a CBA accredited broker was going to be able to be current and have a really good conversation about a CBA product. That seemed to be affirmed by the work that we had done. And as I mentioned, I have no other way of monitoring because there is no activity, and I don't get a view of their total activity in the market, so I don't know. And therefore I made the judgment that the right thing to do to improve quality and meet the customer expectation was to de-accredit the least active brokers in the business.
And you de-accredited them on the basis that they were the least active brokers, and that's what you told them when you wrote to them. Do you agree with that?
Well, that's right. That's right.
You said nothing to them about errors or lower conversion rates or arrears. You told them that they were being de-accredited for volume reasons because they had been inactive.
That's right. And the reason I couldn't talk to an individual broker about their arrears rate or their quality was because they hadn't had any activity with me. So I don't know what your activity, I have no idea what your quality is because...
How does it work then? It can't work both ways, Mr. Huggins. On the one hand, you say they were being revoked because of their lower conversion rates, their arrears, their errors, and on the other hand, you say you couldn't know what those things were.
So the way that I supported my own business judgment was to look at the full cohort. So I could look at a cohort. I could look at the 4,000 or the 1,000, 2,000 brokers who weren't writing much volume and say, well, in aggregate, do I see a difference between those brokers who are active and inactive? And I did see a difference between those that were inactive and active, and therefore, on that basis, I made the decision.
And the differences you saw were conversion, errors and arrears. Is that right?
Yes, that's right.
Conversion and errors are matters concerning the bank, are they?
That's right. Yep.
Not concerning the customer?
No, that's right.
Arrears, yes, that's a matter that concerns the customer, but it's also a matter that concerns the bank, isn't it?
Yeah,
And depends upon the quality of the credit assessment made by the bank on the data that's received from the customer, doesn't it?
that's right.
So
The number
where
of-
does that connect with what you described as meeting customer expectations?
Well-
They're all bank-focused things, aren't they, Mr. Huggins? Now, that's not a matter of criticism.
No, the one that the back and forth, where I'm seeing back and forth where you haven't provided the right information up front, a loan's outside policy, you need to ask the customer for this information, so that then goes back and forth. That can be inferred as actually a person doesn't understand the CBA policies or products, and therefore maybe having the wrong conversation with a customer. So if you see a loan coming in which is outside our policy or doesn't have the right documentation per standard policy, that would infer that the broker doesn't understand and isn't having a great conversation with customers, but they're inferences.
Again, I want to put to you, Mr. Huggins, to give you an opportunity to respond, that their inactivity reveals nothing to CBA about their familiarity with your processes and requirements. They could be very familiar with those processes and requirements and choosing to recommend products other than CBA products to their customers.
Well, I have no way of knowing without activity.
That's
without
right.
activity, and the work that we did when we brought it up to a cohort level showed that there were differences.
In knowledge of processes and requirements, as you refer to them in your statement, did your research or study show that?
It showed that there was more back and forth. It showed that in things like expenses, there were more errors. So because there were more errors, then yes, that inferred to me in my judgment that therefore there was enough information for me to make a business judgment which said that person isn't meeting the customer expectations and is of a lower quality.
What proportion of that group that were de-accredited did you observe errors for?
I'd have to go back, but again, I'd have to go and have a look at that group.
You don't say anything about that in your statement?
No, because the analysis we did was at the full group, and then so having done that analysis, we then said, well, let's take a subsegment of the 700 to then de-accredit. So I don't think we then repeated the same set of analysis on the subgroup of the 700.
It wasn't originally intended to be 700 brokers that you de-accredited, was it, Mr. Huggins? You originally wanted to de-accredit a much larger number of CBA brokers.
That's right. So the analysis that we had done showed that there was a much larger number. I believe it was sort of 2,500 to 3,000 brokers who were inactive and therefore were not those that we believed were going to meet our standards. We started in a pilot of the 700, and then based on that pilot we got a lot of feedback from the market that actually people valued their accreditations with the CBA, and so we consulted widely with the industry, with the head groups, and we had a range of workshops with brokers to understand how could I deliver the objective, which is I have to get some sort of confirmation, something which tells me that this broker understands CBA policies and processes. How can I assure myself as the person that's responsible for these brokers within the business and the experience they're giving customers? And that has led us to the ongoing broker accreditation program, which we've announced, which says you can keep your accreditation if you don't write volume with the CBA. That's fine. We understand it's valuable. But if you don't, if we can't monitor you using activity, then we're going to require you to do some more training on an ongoing basis to keep yourself current.
Can I stop you there and ask why you didn't deal with the existing brokers in that way? Why didn't you explore this theory about errors and arrears and lower conversion rates by requiring them to do more training so that your theory could be tested? Why did you choose instead just to cut them?
Well, I think I've learned a lot from the original 700, which we de-accredited, and I think we've landed in a much better place now, which is that you know we won't de-accredit purely based on volume, but we will require you to do more training. So I think where we've landed is materially better. Why did we do the first 700? Well, I hadn't thought of that as an approach that came out of the consultation that we did. I mean, I wish I'd thought of it. It would have been better. It's where we've landed. My business judgment at the time was, I don't see how someone who hasn't written loans with the CBA can be meeting the customer expectations, and I made a decision to de-accredit the 700. I mean, I wish I had thought of a different approach that we've since landed at, but that's not the way that it worked.
You wanted to de-accredit about another 3,000 brokers, didn't you, Mr. Huggins?
At the time, that was the number of inactive brokers who we had identified, and what I want to do is raise the quality of the brokers, and it remains the case that the inactive brokers that are currently with the CBA, I'm very happy for them to keep their CBA accreditation, but I need assurance that they understand CBA policies and processes and can have a great conversation with a customer. And I don't think that's an unreasonable thing to be asking for people, particularly when they are using the brand of CBA potentially to attract customers into their business. Customers have an expectation that when they see the CBA brand and they see CBA accreditation, that's going to have a certain quality. And I'm going to err on that side of making sure that quality exists.
I want to put to you, Mr. Huggins, that you gave them no opportunity to provide you with the assurance that you sought.
Yes, you're right, but that's a catch-22. I wasn't doing this to drive more volume through those brokers, so if I went out to them and said, you need to prove to me that you've got quality, please write loans to the CBA, then...
I'm not talking about the second part, I'm talking about the first part only. Prove to me that you've got quality. Prove to me that you understand CBA's processes. You're the one who made the link to do that by writing CBA loans.
Yeah, I mean, I made the judgment that on the basis of the evidence we had that I needed to raise the quality, and that decision's on me. I think if I knew what I knew now, I'd take a different approach, and after consultation with the industry, that's the approach we've put in place. But I didn't take that approach, and what I didn't want to do was give people notice and then suddenly someone says, well, hang on, I'm going to start submitting loans to you now. So we didn't do that. We put an appeals process in place instead, which 109 people used.
And why did you pull the pin on the extra 3,000 that you were planning to revoke accreditation for?
As I said before, we received a lot of feedback from brokers. We got a lot of media attention, and that media attention was going down a path of CBAs only doing this to encourage brokers to write more volume with them, and that's not what I was trying to do at all. And therefore I stopped it and said, well, the objective remains, so how do I achieve the objective? And we worked with the industry to do that.
And you're referring there to the new broker accreditation program that is to be launched?
So there's the new accreditation program which has raised standards. We've also announced that for existing brokers, we will monitor them against the same set of quality metrics that we are monitoring head groups and others against: minimum living expenses, interest-only owner-occupier, the conversion rates, the quality of the loan and customer feedback. So we'll monitor existing brokers on that basis as well. Where people meet those quality metrics, that's fine. Where they don't, or where we have insufficient activity to actually use those metrics, then we'll ask people to do some more online training, just to give myself some certainty that those people can deliver the quality of experience that the customer expects, and as rightfully Commissioner, you identified before, and that they're high quality for me. So from a bank's perspective, I don't need to spend as much processing those loans, because there's not as much back and forth, which is expensive for me and a poor customer experience.
Could I show you some documents that
Sure.
aren't in your statement that I'd like you to identify and to tender,
Sure.
Mr. Huggins? The first is CBA 0508 0002 0004. So this is a letter from CBA dated 20 February 2017. Is this one of the de-accreditation letters that was sent to brokers?
Yes, it is.
And you'll see that what the broker is told there in the third paragraph, we have identified that you have not been active with Commonwealth Bank for some time. Accordingly, we have made the decision to resign your accreditation with the Commonwealth Bank in accordance with our agreement with your head group, and have advised your head group of this decision. 14 days notice, commencing from the date of the letter, and the bank's going to exercise its right to revoke your authority to act. You will no longer be able to submit home loan applications. Effective immediately, we will not accept any new home loan applications from you. So was this the letter that went out in the first phase of de-accreditations?
Yes, this is the letter that went out. There were two phases.
I have a second letter as well, which is undated, and I can show you that one if it assists. The second letter is briefer than this letter. I'm not sure if that helps you.
This is the letter that went out to brokers that were de-accredited. Yes, there were two phases. I tend to think of them as the same. The first one had sort of 100 brokers. The second one had more, but
yes,
they're effectively the same.
So you think this was the first phase?
Yeah, I think so.
And you mentioned that there was an appeal process available to brokers. Is there any mention of that appeal process in this letter?
So the appeal process was available through the relationship manager. So we asked people who wished to discuss the decision to contact their relationship manager, and through that they could access the appeals process.
Yes, but nothing in this letter to suggest to them that there was a way of challenging the de-accreditation. Quite to the contrary, effective immediately, we're not accepting any new home loan applications from you.
Well, we encouraged them to have a discussion. We wanted to have a discussion with them and their relationship manager, and that's what we said in here.
I see. I tender that document, Commissioner.
Yes, CBA 0508 0002, 0004, draft accreditation letter, 20 February 2017, will be Exhibit 1.31.
And I'm not sure if you were here for the evidence of Mr Harris
I did see
yesterday,
Mr. Harris,
Mr Huggins,
yes, I
but
was.
you would have seen that this is the form of letter that was sent to him.
Yep.
Now, could I show you next CBA 0508 0002 0001? This is the other style of letter that went to brokers,
Yes. Yep.
much briefer.
This is the more standard revocation that would go for more BAU revocations.
BAU?
More business as usual. So if the revocation was
Right.
as part of ongoing, as we mentioned before, there was
Yes.
then-
Other
then
grounds?
Other grounds. then
So
there's-
was this letter used in the de-accreditation program?
I don't believe so.
No, thank you. I will nonetheless tender that document, Commissioner.
Exhibit 1.32, CBA 0508 0002 0001. If I call it standard form notice of revocation of authority to act, does that sufficiently capture the
Yes, I think so, Commissioner.
title?
You've given us a figure today, Mr Huggins, of the number of brokers that were de-accredited, which is 710.
That was the number of brokers that we sent the letters out to, I believe, yes.
And is it fair to say it took you some time to be able to provide that figure to the Commission? You provided draft versions of your statement and a final version of your statement in which you were unable to say how many brokers in total had been de-accredited?
I think we were able to get to the numbers on the de-accreditation side, but at the BAU, the business as usual side of determining how many brokers were de-accredited was much more challenging for us. We keep in our systems a current list of all accredited brokers, and that's our focus on making sure that anyone who's currently accredited with us is current. And the Commission asked for us to go to a point in time back, and we don't keep those point in time records, so we therefore had to reconstruct the data for the Commission, and that required my team and a number of other people to go and do that manually. So it was quite manual, and I apologise for how long it took. It's not something we'd do in a normal course of business.
We now know. We now know the number, and your supplementary statement gave us that number. Was it any part of the decision to de-accredit these brokers, was any part of the thinking there aligned with this objective that I asked you questions about much earlier in your evidence, of changing the proportions of the proprietary channel and the broking channel?
Not really. I mean, we certainly had discussions at the time around, because there was very little volume coming in, that it was unlikely to have a huge impact on the business, and also that part of our conversations at the time were and continue to be a desire to build actually a very good, strong broker proposition, and that having fewer brokers, may have meant you could focus your resources on those fewer brokers and provide a better level of service, but it wasn't directly linked to the proprietary side, sort of directly.
Can I show you another document, Mr Huggins, which is, again, not in your statement, CBA 0513 0002 0069. Have you seen this document before, Mr Huggins?
Yep. Yes.
Could you explain what it is to the Commission?
This is a document which is produced by our communications team when there are sort of major events happening, and this looks like, from the issue name, ASIC Mortgage Broker Review, so I think this would have been when the mortgage broker review was coming out, and it assesses, discusses the issue and then assesses impacts on the bank.
Could I direct your attention to the second page of this document? It's 0070. Reputational impact analysis. Do you see that section there?
Yes.
And can I direct you to the last two paragraphs? Since the full year financial results, Commonwealth Bank has come under pressure from equity analysts and shareholders to rebalance home loan flows in favour of our proprietary lenders, where we make a higher margin. Commonwealth Bank is introducing a number of initiatives to achieve this. For example, it is seeking to reduce the number of mortgage brokers that are accredited with us. I'm sorry, you'll need the next page. It is seeking to reduce the number of mortgage brokers that are accredited with us, which are either inactive or providing very little business. Now, do you accept that this is part of the thinking that sits behind the de-accreditation program, as this document records?
Oh, this is not how we thought about the de-accreditation process. I think, as I mentioned before, we knew that we weren't getting a huge amount of business from these brokers, and therefore it wasn't going to have a material impact on the proportion coming through our proprietary channel. And our focus on the proprietary side had been to grow the number of lenders and investment in that space. So,
but nonetheless, it's consistent with the objective that I think you acknowledged earlier of rebalancing the home loan flow to the more profitable proprietary channel rather than the broker channel.
no, that's right.
Yes.
I think, I don't think what's written here is correct, that the way we would be able to achieve rebalancing the home loan flows was by de-accrediting brokers, and that wasn't something which was a objective in terms of rebalancing the flows. But there was a broad objective to raise the proportion through proprietary, but this de-accreditation we didn't think would have achieved an outcome of de-accrediting, of raising proportions.
I can't recall, did I attend? I don't think I've tendered that document yet, Commissioner.
Exhibit 1.33, CBA 0513 0002 0069, reputational impact brief, 10 March 17.
Can I take you to a document in your statement, Mr Huggins, part of your exhibit DH14, which is a very large number of documents. It's a number of sets of minutes from third-party broker governance forums. And the one I want to show you is from the 27th of April 2017. It's CBA 0507 0021 0051. Sorry, if you just give me a moment to find, in amongst all these minutes, the correct one. Right. Now, can I ask you to look at 0054 in this document? And just show you the reference there to the 27 April 17 update. BK stated phase 1 and 2 was 700 brokers. Phase 3, 3,000 brokers, has been put on hold due to the changing environment in the broker space. The current focus is on developing higher standards for new brokers. The overall objective is only to accredit committed and quality brokers with the aim to reduce the flow of incoming new accreditations. Strategy is being reviewed by legal and will be presented to Dan Huggins. Now, is that an accurate reflection of the situation in terms of the phase 3,000 brokers being put on hold?
It was put on hold, both due to the changing environment and the, what's not, as I mentioned before, the feedback we got from the industry and the media. And then we went into a consultation with the industry about that, about our new accreditation and also ongoing.
And you referred to the media attention that CBA got at that time, which you may have seen an email in the documents provided to you, an email from you in which you referred to the media fallout. Do you recall that?
Yes.
Yes, and that media fallout was a reason, if not the primary reason, for abandoning the move to de-accredit the further 3,000 brokers.
The fallout I was referring to was that the narrative which had been picked up in the media was that we were doing this to try and drive volume in through our other accredited brokers, which was an incorrect narrative.
I'll show you one more document, Mr. Huggins, which is also not in your statement. It's CBA 0513 0002 0001. Now, this is another document in the same style as the previous one we looked at, another reputational impact brief. Now, can I direct your attention to the second page of the document, which provides a timeline for the de-accreditation process? Is that right?
Yes.
And we see there the way you selected the brokers who were to be in each phase of the de-accreditation.
Yes, at that time I think it changed slightly from this document, but it's approximately correct at that time.
Sorry, Mr. Huggins, you're dropping your voice again. Do you mind repeating your answer?
This was the criteria at the date of this document. I think it changed a little bit until we got to the final list of people.
So do we see there, I think you mentioned that the first phase, what you originally referred to as the first phase was 700, but you accepted that there were two phases.
That's right, yeah.
And that the first part of that was 100 brokers.
Yes.
And they were chosen on the basis that they had been accredited. We'll need to go to the table below the part that is on the screen at the moment. The 100 brokers were chosen on the basis that they'd been accredited in 2013 or prior. They have no book with CBA and they have not settled a deal in FY16. No applications submitted year to date. So that they were the criteria for identifying the first 100.
Yes.
And then the next 600 were identified on the basis that they'd been accredited for more than 12 months, had no book with CBA, had not settled a deal FY16 and had not submitted an application year to date.
Yes.
So the only difference being the period for which they'd been accredited.
Yes, that's right.
So that's how the 700 were selected. We see no reference in this document, do we, to selection on the basis of any of the matters you referred to before about errors or arrears or lower conversion rates?
So a couple of things. That wasn't the 700, so that there was the 100, which is correct, that's the first phase, but under the stage one there, I believe we ended up with fewer people than 600 in that first bucket, and we ended up with a number of people out of the other two buckets. In terms of your second part of your question, there's no reference to that. There's not that work had been done separately, and then I'd made the decision that we should begin the accreditation. So this was the criteria upon which these groups of people were made, but the work that had been done was separate to this.
Mm-hmm. And we see a reference to stage 2, 2,310. That's the phase that ultimately went to about 3,000 brokers but was abandoned.
That's right.
Yes. I tender that document, Commissioner.
Exhibit 1.34, CBA 0513 0002 0001, reputational impact brief 11 April 17.
Mr. Huggins, how many Aussie brokers had their accreditation revoked by CBA as part of this program?
So no franchised brokers were included in this round of the program. So no one from Aussie or other franchises were in this round.
Mm-hmm. And we've talked briefly about the appeal process. If a broker knew about the appeal process, there was a requirement on them to submit information in support of their appeal. Is that right?
That's right. They had a conversation with their relationship manager, and then the relationship manager would write the appeal on their behalf.
Could I ask you to look at a document in your exhibit DH17 at 3816? I'll ask you to look at the first page of that first, so you can familiarise yourself with the document. This is a document from 23 January relating to the accreditation review.
Yes.
And can I ask you then to go to 3816 in that document?
Mm-hmm.
I'm sorry, I haven't provided the doc ID. The doc ID is CBA 0001 0030 3813. Sorry, Mr. Huggins, you and I know what we're talking about, but no one else does. So that's the front page of the document. And can I ask you to go to 3816, which gives brokers were required to provide if they submitted an appeal. Now, one of the things that they had to tell CBA about when they put their appeal in, the last bullet point from the bottom, was the total funding figure and value with other lenders for FY16. Why did CBA want to know, as part of the appeal process, about recommendations by the broker to other lenders?
Well, we wanted to know in general whether the broker was active in the industry or not.
And what would you do with that information as part of the appeal?
That, together with other information, was used to determine whether it was appropriate to continue their accreditation. But we wanted to make sure that people were actually committed to the industry and were active in it.
What would you have thought if the person providing the information revealed that they had been submitting significant amounts of loans for significant amounts of money to other lenders? How would that have factored into the decision on the appeal?
Well, it would have shown that they were active in the industry, but we didn't accept any appeals purely on the basis of volume.
This is volume to others, not volume to you.
Well, we did not accept any appeal on the basis of volume alone. So someone coming in and saying, well, please don't de-accredit me, I'm going to write you a lot more volume, was not a basis upon which we accepted an appeal.
I think that's a different point, Mr. Huggins. I'm asking you, the person or body deciding the appeal,
Mm-hmm.
if the information provided showed that the particular broker had submitted a lot of loans to other lenders in FY16, would that have counted for or against their appeal?
Well, it would have counted for it in that they were active in the industry, but it wouldn't have been taken as the only factor.
I see. All right. How many brokers did appeal the revocation of their accreditation?
My understanding is 109 brokers.
And how many appeals were upheld?
23.
And on what basis were those appeals upheld?
There are a range of reasons, but there were some where the person had been out for medical reasons or had been travelling. There were other reasons where brokers had recently been refocusing their business on consumer lending, but perhaps they'd been focused on business lending. So there were a range of reasons.
What did you make of it when, as you've acknowledged happened, in the appeal process, CBA brokers said to you that they would promise to send more loans to CBA? What did that suggest to you about what brokers understood of why their accreditation had been revoked?
I don't recall thinking about that at the time, to be honest.
Well, do you accept that the fact that people were promising to write more CBA loans shows the message that they were receiving as a result of this de-accreditation process, which is a message that they were being revoked because they had been submitting insufficient numbers of CBA loans.
I mean, unfortunately, that was the narrative which was also in the media and in the industry press. So that was the narrative that had been picked up, which obviously, if we discussed, wasn't the purpose or the objective, but that was the narrative that was being picked up.
You heard the evidence yesterday of Mr Harris in relation to the revocation of his accreditation. You're familiar with Mr Harris?
I've never met Mr Harris. The first time I saw him was yesterday, but I'm familiar with the case in terms of preparing for today.
And you know that he spoke out to the media about the de-accreditation program after his accreditation was revoked?
I'm aware of that only through the media articles quoting him, and his testimony yesterday.
Yes, and the media articles were drawn to your attention at the time, were they not?
Yes, they were.
And could I just show you a document which is CBA 0513 0002 0107. Sorry, I have that document now, and I want to be careful about redactions in this document. Do you see from this document, Mr Huggins, that you were one of a number of people to whom an article quoting Mr Harris was sent on the 24th of February 2017?
Yes.
And you see your response having received that article?
Yes.
Here's the Fairfax article, let's see if Mr Harris appeals, exclamation mark.
Yes.
I tender that document.
Exhibit 1.35, CBA 0513 0002 0107, email Huggins to Vaswani, 24 Feb 17.
Why was Mr Harris's accreditation revoked, Mr Huggins?
Mr Harris fell into one of the previous categories that was identified, where he had only funded one loan in the previous 12-month period, so he was captured in one of those broad segments and was picked up to go into that first group, phase 2, I think it was, in the annual lecture.
Were there any high arrears rates connected with his loan or previous loans he'd submitted to CBA?
No, he didn't have a book with us, so he only had the one loan, I believe, so obviously you can't calculate the arrears.
Yes, so any problems with the loan that he submitted in that year prior to his de-accreditation?
There were actually two loans submitted. The first one loan was submitted in June 2015 and one in I think it was August 2016. The 2016 loan, yes, did have a couple of problems. It failed our original sort of gate to be accepted. It was missing, I believe, a statement, an OFI debt statement, which is a statement from another financial institution, which is required for that loan to progress through. So it went back to him, so I had to go back and forth. And then the loan came in, was subsequently approved, and then later in the stage we discovered that on the customer onboarding form there was also an error, and I believe the product hadn't been selected, and we needed to go back again and get that information. So there were some problems with that loan, and then the loan which was submitted in June 2015 was ultimately declined. That loan was a loan which was outside policy. The 2015 loan again failed the original sort of check, and then when it came back in, it was outside CBA policy. The LVR was higher than allowed within CBA policy, and it failed servicing. So that loan was declined.
And those things you've just mentioned had nothing to do with the de-accreditation of Mr Harris's Mr Harris's de-accreditation, did they? He was selected because he fell within the 100 brokers who met the criteria for the first phase.
Right, but I think it provides a useful illustration of what we were trying to do, which was, I mean, coincidentally, and as I say, we didn't go and look at that particular broker before he was de-accredited, but it does provide a useful insight into about why we undertook this, which was we've got a loan in 2015 where a customer has had a conversation with a broker, and they've put an application in which was never going to be approved. It was outside policy, the LVR was too high, and it failed servicing. So there has been a conversation with a customer for a loan which was never going to be approved. That is precisely what I would like to avoid, and therefore why we're trying to get better assurance among our brokers to try and stop it from happening. It doesn't need to be linked to volume, but it doesn't. I do need to assure myself that that doesn't happen.
Did anyone address those matters with Mr Harris?
I don't know that. I don't know that information. I mean, unlikely. There's 13,500 brokers, and we're getting thousands of loan applications in. So I'm unable to go and talk to every single broker about every single loan they put in that fails, and therefore I'm forced. I have to put in mechanisms like the ones we've now put in place and the ones we had in place at the time to try and make reasonable business judgments about when certain groups of people are going to be able to meet the customer expectations and the business needs, and that was the judgment I made. And I think the example we've just talked about is a good one of that's not a great customer experience, that's not good for the Commonwealth Bank, that's not good for the customer, and so...
But no one raised that with Mr Harris, and we see from the emails that you would have seen discussed in his evidence yesterday that your own people at CBA tried very hard to help him overturn the de-accreditation.
Well, they tried. I mean, Cameron, who's the state manager, suggested that he would put an appeal in. I mean, that appeal then would have been assessed, as with all of the other appeals. It didn't get to that point. But to your question before about no one discussed, as I said, there's 13,500 brokers. We're getting thousands of applications every day. I can't take every loan which gets declined like that, and therefore I have to put some other mechanisms in place and to do that, and that's what I did with the de-accreditation. And based on the feedback that we got, we've now, I think, moved to something which is better, which is that people can keep their accreditation. It's not linked to volume, but you're going to have to do some training so that I can be assured that you understand the CBA products and processes.
Have you reduced the fail rate?
Pardon?
Have you reduced the fail rate? That is the declining of proposal.
No, we haven't gone and done the de-accreditation of all of the large brokers.
Have you reduced the error rate?
I'm not sure the error rate has been. I'd need to check whether that's come down.
Well, so far as your evidence presently goes, the changes you've made, you're not conscious of those changes affecting either of the purposes of the change, namely reducing fail rate and reducing error rate. Is that right?
Well, on the 710 brokers, it would be insufficient to move the entire bank's fail rate, but I would expect over time, based on the process that we have in place now for accredited brokers, that those measures will absolutely decrease but it's going to take some time to flow through.
Can I, just before we leave Mr Harris as a topic, before we leave Mr Harris as a topic, Mr Huggins, show you another document which is CBA 000101005795. And this is an email sent by Cameron Baisley, who you described as the state manager in Queensland, to other people within CBA, dealing with Mr Harris, explaining his business, referring to the issue in the middle of the page. We notified Mark that he would be resigning his accreditation due to low volume. I had already commenced an appeal for his accreditation due to his history and potential. I was working with Becky Rass at AFG to obtain some information to assist with this appeal. In the meantime, Mark has clearly been active in social and print media, Broker News and SMH, advising journalists that CBA is resigning accreditation. I've been trying to book an appointment with Mark to go out and discuss this with him directly, but as yet we have not finalised a date. Recommendation. Given Mark's activity in the press, I am now not sure he is someone we want to honour an appeal for. I would like to speak directly with Mark and understand if he is keen to partner with CBA and will operate in line with our values. Therefore, any appeals for accreditation from Mark should be parked. You seen that email before, Mr Huggins?
Yes, I've seen that email.
And it's true, isn't it, that CBA took a dim view of Mr Harris after he engaged with the media about the de-accreditation program?
I think we were uncomfortable, as I mentioned before, with the narrative which was in the press, which I believe Mr Harris was talking to, which suggested that this was all about us trying to raise volumes with other brokers, which it wasn't about. And as is indicated here, we'd been unable to meet with Mark to discuss that with him.
I tender that document, Commissioner.
Exhibit 1.36, CBA 001 0100 5795, email Baisley to Moore, 24 Feb 17.
Now, Mr Huggins, the de-accreditation program followed a review that you've spoken about of brokers that was conducted in late 2016 and 2017 at CBA.
Yes.
Yes, and you oversaw that review.
Yes.
And as a result of that review, CBA has announced changes that you've referred to already in your evidence to its broker accreditation program.
Yes.
There's currently a freeze on the accreditation of brokers, which will shortly be lifted, and a new broker accreditation program will be put in place.
That's right.
And a large purpose of those changes that are being made is to ensure that CBA accredited brokers are experienced in residential lending. Is that right?
Yes, that's right.
Okay. Could I ask you to look at CBA 0001 0031 0121, which is your exhibit DH16. And this document was prepared for internal purposes to assist CBA people to field questions about the changes to the accreditation program. Is that right?
Yes, that's right.
Can I ask you to look at 0125? And direct your attention to 3.3 and 3.4. Does a potential candidate need to meet all criteria before they're able to submit an application for accreditation? Candidates must meet all of our criteria. There is only one instance where we will consider an exception, which is the minimum levels of residential lending experience. We will consider these exceptions based on head group nominations and the candidate's track record of delivering good outcomes, as well as the training and mentoring they will receive. Down to 3.4, a reference again to that one exception and the same basis for it. Now, what I want to ask you is how that fits with the driver of this new accreditation program being to ensure more experience, to have this sort of exception in the program.
Well, the new accreditation program is designed to ensure that brokers are able, to have a good conversation with customers about CBA products, and therefore, this is one of the requirements. And whilst we allow an exception to that where there is a solid training and mentoring program around it, we're still requiring brokers to have access to that experience, and then the other elements of the accreditation also feed into that. So we require a diploma, we require that a person is a direct member of an ACL, of one of our approved ACLs, and also a member of the MFAA or the FBAA. So,
Sorry, Mr Huggins, again, you're dropping your voice.
sorry, I'm not used to. So all of the changes that we've made to the accreditation are designed to make sure that a customer is going to have a good experience with that broker, and that the quality of brokers that are accredited with CBA is of the highest possible standard, and this requirement of 2 years minimum experience affirms that. We will make exceptions where there's an approved mentoring program with someone of experience, but the other elements of our accreditation program also reinforce the desire to have a very high quality broker who's able to have a very good conversation with a customer from day one.
I have one further topic to cover with you, Mr Huggins, but it can't be done within a few minutes, Commissioner. So
The only other matter of housekeeping that I think may or may not be necessary is I don't know that you've tendered the letter of Mr Narev to the Sedgwick.
I have not.
Do you intend to?
I do, Commissioner, and I can tender that now. I think it's the only one I've missed so far. It's CBA 0001 0038 0929. That document is both the letter from Mr Narev to Mr Sedgwick dated 10 February 2017 and the annexed issues paper submission that I referred to.
That'll be Exhibit 1.37, the document as you've just described at 2 o'clock then. Yes, Ms Hall.
Mr Huggins, I'd like to take you to paragraph 63 of your statement, where you refer to controls that CBA has in place to ensure compliance by head groups and your aggregated mortgage brokers. You have that paragraph
Yes, I
there.
have that paragraph, yes.
And the controls that you list in that paragraph include a reference to a file review process that's done by CBA's credit support and monitoring team. You refer to that in subparagraph A.
Yes.
How often do those occur?
So that, I think that's referring to the credit and support team. So it occurs on a randomised basis across a statistically significant sample of the population. So it's hundreds of applications, but it's it's quite regularly across the population. But obviously that means that for any particular lender or broker, given a statistically significant sample across the population, that it may not be that frequently for a lender or a broker.
And the second control that you refer to here, this is control over your accredited mortgage brokers and head groups, is
Yes.
a targeted review process.
Yes.
And that's done by CBA's credit support and monitoring team and happens when CBA is notified of something that requires review. Is that right?
That's right. So that's the same team, and they will, where we've identified a broker, either we've been notified or where we have identified there may be cause to look at a specific broker, they will on a targeted basis start pulling out applications and reviewing those.
And the third control you refer to, the third CBA control over its head groups and mortgage brokers, is the Head Group Assurance Program.
That's right.
And this is a program that requires the head group to comply with particular obligations and for its representatives and employees to comply with those obligations.
That's right. And that assurance program is linked to the document we looked at earlier, which has that sort of exhaustive list of things we go and look at with the head groups.
So this is about requiring the head group to do the right thing. It's not really a CBA control as such, it's requiring the head group.
No, so as per that document we looked at before, CBA will go in and look to make sure that the head group has, for example, the compliance documents or those conflict of interest documents we were talking about before. So it's us auditing the head group. A committee which sits underneath the Home Loans Sub-Risk Committee, and the intention is that we have a group of people who are meeting once a month who are actually providing oversight and reviewing all of the things that should be going on in the business to make sure they are. So my Simon Kwan, who leads my operations business, will be, he'll talk to operations and Bill Kantaris will talk about what's been happening in the BIR process, which is our broker investigations business. He'll talk about de-accreditations, and then there's what we call line 2, which is the business is me, and then there's independent oversight, which is what we refer to as line 2. They also come in and report, and they're overseeing whether our accreditations are appropriate, whether that is all working. So we have both lines, and the intention of this committee is firstly to make sure that that's happening, and then also if there are other decisions that need to be made around the broking business, they would come to this committee. So when I referred before to changes to our accreditations model, then they'd go into this committee first and then up through other approval stages.
Could I ask that you be shown a document, Mr Huggins, which is CBA 050800010029? Now, could you explain what this document is, Mr Huggins?
Sure. So this is an internal audit document, what we call line 3. Just to explain that, the business, as I mentioned before, line 1, line 2 would be our normal internal risk function, and then the audit function is oversight across all of that. This is the summary report, and then there'll typically be an issues log that sits in behind this. This report. The report's generated, for a specific purpose in the business, and we'll assume that you understand, the business and you have the context of what's happening in the business. They don't sort of go into all the details of the layers of control or anything like that. They kind of assume you understand that, and then they'll document their findings here and in the issues log.
And who are they?
Sorry, that's the audit group, the independent audit team that works within CBA.
Yes. Now, this document relates to an internal audit of the CBA retail brokers, is that right?
Yes, that's correct.
Within the home buying retail division, your division.
That's right, yes.
And you are described in the third line of the document as the accountable executive.
That's correct.
And this document is a document from towards the middle of last year, the 16th of August 2017.
That's right, that's when the document was written. I believe the review period for this was around May 2015 through until May 2017. So the review period was before, obviously, the document was written, covers that 2-year period, and then the document was written on that date.
Mm-hmm. So in this report, there's an assessment of various things in the retail brokers area.
Yes.
For the 2 years preceding the report. Is that right?
For the specific areas, yes, that they've identified in the report, yes, that's right.
So could you explain this report rating box to us at the top?
Sure. So there's 3 ratings which you can generally get, which would be satisfactory, marginal, or unsatisfactory. Obviously, in this box, satisfactory is that things are going, sort of perfectly well. If it's a marginal, it's there's opportunities for improvement, and obviously, if it's unsatisfactory, then that, as it would suggest, would mean that there are more unsatisfactory findings.
So what does amber mean? You haven't referred to amber.
Sorry, so amber is the overall rating. Again, you can either have green, amber, or red. Amber means, generally that there are things to focus on. So when we look at this, this would show marginal and control environment. So there's areas that need to be improved in the control environment. Management awareness and actions is satisfactory. So that means that management is aware of those gaps and has plans in place to resolve those, or indeed they may already be solved because this report's written after the review period. And then amber, if you've got any marginal in there, you're going to get an amber. So the only way to get a sat on the overall report would be for them both to be satisfactory.
So what are the available ratings for the control environment? Marginal is the one
Marginal is the
here.
middle, so you can have satisfactory, marginal, or unsatisfactory.
I see. So marginal is somewhere between satisfactory and unsatisfactory.
Yeah, it means there's things to improve.
Yes. So do I read this correctly as telling us that the last time this audit group looked into the broker's part of the business, the control environment was also rated marginal in 2014. Management awareness and actions were also rated satisfactory, but the overall report rating was amber, as it is in 2017.
That's right. I mean, the issues aren't necessarily the same. So when they look in the control environment in 2014, I haven't reviewed that report, but you know, the environment changes in the couple of years that the reports are generated, and what made the report marginal in 2014
Might be different.
might be quite different from
Yes.
what's made it marginal
But
now.
in any event, the
But in
control environment hasn't moved up to satisfactory. It's still only marginal in 2017, perhaps for different reasons.
Right. So the control environment may have lifted overall, but if the general view of audit is that it needs to lift further, you can still be marginal.
And what are the consequences of a business area such as the broker's business area receiving an overall report rating from the independent auditors of amber?
Well, that would come into mine and my team's ratings. It links to management awareness and actions, and then Matt Common, who's my manager, would look at that and determine whether that should affect my KPIs or not. And so my bonus at the end of the year.
Mm-hmm. Any other consequences apart from remuneration consequences?
Well, for the leaders of the business, it would be remuneration. I mean, it also directs where we go and invest, and certainly, and as is the case in this, there were some things identified that resulted in us redirecting, investment and management attention. So it may also result in management time and attention being redirected, roles and resources being redirected.
Yes, I see. So we see the audit conclusions on this page. The first is that there was a need to reprioritise some initiatives and develop new ones to give greater comfort over key tasks performed by both aggregators and brokers on CBA's behalf.
Yep.
If I could take you down to the next paragraph. In addition, management needs to assess and determine whether aggregators and brokers are complying with the relevant key group policies they are contractually obliged to comply with. So the conclusion of the audit group is that there are issues, sorry, I've lost the page from the screen, there are issues with whether or not CBA is assessing and determining whether its head groups are behaving in a compliant way.
So as I mentioned before, the audit and the report is written, for a specific purpose. Audit is going to look at the business, and it's going to isolate specific parts of the business that need to be improved, and just focus on those, and then sort of ignore the broader context and layers that sit around that. Well,
the role of the audit group is to identify the problems that need to be addressed, is it not?
It is, and they do that by looking, for those problems, and then they isolate them. So, although there may be multiple layers of redundancy that exist within the system to ensure that you're getting an overall good outcome, they're going to focus on a very specific part and say this part in isolation can be improved, and then they'll report on that. They don't, and that's appropriate. I want them to identify where I can improve the business, and that's exactly what they do. But they don't talk in here about all of the other things that might be happening in the business to give ourselves assurance.
No. But what we see from this document is that they identify significant problems in relation to the monitoring of aggregators and brokers by CBA. This is in August 2017.
Yes, they identify some areas that need to be improved.
And as a result of that, the control environment is rated marginal only.
That's correct, yes.
Yes. So could we turn to the second page to look at some more specific findings of the audit group? The key themes from the audit are below. Do you see that reference, Mr Huggins, on the left-hand side of the page?
Yes.
The first is that home buying do not have sufficient oversight of aggregators to confirm they are meeting key legislative requirements they are required to perform on behalf of the group. That was one of the findings of the audit group.
Right, so the way that Audit is going to document its findings, as it does here, is it's going to create the risk theme, which is what they talk about there, and then they're going to get into the detail. So here they say, you know, the general theme is that we don't have sufficient oversight, and then they get into the very specifics. So they talk about EDD, and we can talk about that in detail if we want. So they...
Well, let's talk about one of the details, which is that management relies on aggregators, that's CBA management,
Yes.
relies on aggregators to have a robust monitoring program to check that brokers comply with the National Consumer Credit Card.
Absolutely.
Credit Code, I'm sorry.
That's right, yes.
So why is that? Why is CBA relying on aggregators to do that when CBA has its own legislative obligations to do that?
So I don't rely on aggregators to meet my NCCP obligations. So, you know, where it pertains to responsible lending and my NCCP obligations, I am assuring myself, you know, from primary information that I'm lending responsibly and meeting my obligations. The broker, though, has its own obligations. The head groups have their own obligations under NCCP, and one of those we talked about before, for example, around disclosing commissions or around doing a needs discovery exercise to ensure that the needs and objectives of the customer are appropriately understood, and then you know, some of that information is provided across to me. So I'm relying on, you know, on them to make sure they're meeting their NCCP obligations, and that's what this is referring to. But I'm not relying on a aggregator or a broker to meet my NCCP obligations where it pertains to ensuring that the loan which is written is appropriate for the customer.
So is the point here, the finding of the audit committee, that CBA is not doing enough to ensure that brokers and aggregators are meeting their legislative requirements?
That's right. And then
Yes.
and then when you read the detail, it linked into the, again, that detailed sort of, I don't know, 5 or 10 page document we had before of how are we going to go and assess whether those systems are appropriate, whether the compliance systems are appropriate, and it gives up another layer of certainty. So if an aggregator has a really, really great compliance program, and some of them do, then that, you know, gives me more confidence as well. It doesn't mean I stop doing my own assurance programs or the credit support and monitoring team, but it does give me another layer which is good for me. So.
But the overall findings of this document, there's a number of themes identified in here. The overall findings and the reason the retail brokers group was only given a marginal control rating is that CBA is not doing enough to monitor the activities of the head groups and the mortgage brokers who sit under those head groups.
Over the review period, that was right. Obviously, we'd started doing that work, and it linked into it. But as I said, you know, that there's quite specific things in here which it doesn't consider the full system that's in place. But yes, the audit identified improvement opportunities in the broking business, and I'm fully supportive of those, and we've gone and taken action. It was the point of the audit.
I'll just show you briefly 0033 because we can see that an appendix to this document is a summary of the very high to medium audit issues.
Yes.
And the high audit issue is risk exposure where the aggregators or third parties are not performing and monitoring activities has not been assessed by home buying, and that issue became an issue that you had responsibility for.
That's right. I think that issue had already been raised by us before, but I do have that as a high issue. I believe it was self-identified, and their findings link into that risk, and you know that links, you know, again back to the work that we're doing, having identified this risk, to go and audit the head groups in detail to see whether this is happening. So it's absolutely a risk that we've identified in the business, and doing work to, have done work to improve.
Could I just take you to Appendix C, which
Sure.
contains commercial insights for management's consideration? Is that a standard part of this sort of document?
Well, the way an audit will work is they'll identify the issues and they'll be documented in that issue log. They may have other observations which don't justify putting in a specific issue, which then requires a specific action. So these are sort of the, look, we've seen this as well, that you may want to consider it as management, but it's not a big enough issue for it to be made an issue, otherwise it would have been put into the issue log. So this is sort of observations for things to us to think about.
And the first one of those, the first dot point in row 1, it is not industry practice for banks to complete assurance, and hence aggregators do not have well-established processes for providing access to their people and deal files. Now, is that a reference to it not being industry practice for banks to complete assurance over head groups?
Yes, that's
Yes.
right. So
And why is it not industry practice for banks to complete assurance over the head groups through which the customers come to CBA?
Well, I think, and I can, from my perspective, from the bank's perspective, I think we are assuring ourselves of of our obligations and making sure we're lending responsibly. I think historically we haven't extended that out to the other NCCP obligations of the head groups, but that is starting to happen. As I mentioned, we have started doing it. The other thing that has happened is we're currently part of an industry initiative where PwC is performing this on behalf of a range of different banks. So we'll end up with, a industry once a year review of the head group, which can then go into detail. And we've put our approach into that. We've provided that to PwC, and they have themselves added a range of features, as have the other banks, to make sure that we get at an industry level, a really thorough annual review, at least annual review of the head groups. So that work is happening. But and I guess part of this finding was seeing that, and it's a good observation.
And how are we going to fix this problem that because there hasn't historically been assurance by banks of head groups, that they don't have processes for providing access to their people and deal files, which is connected with another of the dot points, the last one, as it is not industry practice for ACL holders to be subject to assurance, the aggregators sometimes encounter resistance from those brokers to provide documentation for review and Q&A. So you might well have your annual industry assurance of a head group, but what's happening to assure that that can be an effective process?
Yeah, I mean, we're working closely with the head groups, and I have to say they have been very engaged, and the ones we've spoken to so far, we haven't spoken to all of them, but the folks we've spoken to so far have been very engaged, and they want this to improve too. And certainly as we've had findings and gone back to the head group and said, look, here's where you can improve, they've been really open to that. So it is a challenge. It's a challenge for the head groups, but I would suggest, my experience with those head groups has been that they are keen to make this work and keen to see this type of thing happen at an industry level, so they can identify how they can improve, and those hurdles are for the head group to overcome, and they're trying to overcome them.
And they become CBA's hurdles to overcome as well, don't they?
Sure.
Given that customers deal with CBA through these mortgage brokers.
Of course, and as we suggest, as I mentioned earlier, the CBA accreditation comes with some customer expectations that I want to make sure they're met. So yeah, they become my problem as well, and we're working closely with the head groups to make sure that they're resolved. But I have not yet, and I doubt this will happen, I hope it doesn't, I have not yet had to pause or stop any activity because a head group has been resistant to CBA coming in. And we saw in the document before, and what is quite an intrusive process. I mean, we look through everything, and that is on that list. It's quite extensive. So
This is for the 3 you've done so far?
that's right, the 3 we've done so far, and then obviously we're now at the industry level. So
All right, I tender that document, Commissioner.
Exhibit 1.38, CBA 0508 0001 0029, Internal Audit Report 16 August 2017.
The last document I want to show you, Mr Huggins, is what I think you were referring to before as an issues log.
Yes.
It's CBA 050800010001. Am I right? Is this an issues log of
Yes,
the
that's
style
right.
that you had described before?
Yeah, that's right. So this is you've got the summary, which is the one we just looked at, and then behind that there's the more detailed issue log, which gets into the detail of.
So this is the issues log for a different summary, because this is dated the 5th of September 2017.
No, it's
the same
linked.
one?
It's the same one.
I see.
What will tend to happen is that because management has to write management actions against this, audit will complete its findings. Management will then write its responses, and
I
so
see.
it'll tend to get finalised a little later.
So these are companion documents?
They are companion documents. That's
And
correct.
the issues listed in here are the issues that underpinned
That's
the
right. Yep. So
report
you'll see the
findings.
titles. The issue titles here are the same that are referred back to in the previous
Okay,
one.
and again, you're listed as the accountable executive for this.
That's right.
And the first issue is risk exposure due to lack of management's oversight on aggregators and aggregators' oversight on brokers have not been assessed by home buying.
That's right. So
And
that
there's-
links back to the same one we saw a second
That's what
ago.
we've been discussing.
Yeah.
And the issue rating is high,
Yes.
and the impact is major,
Yep.
and the likelihood is likely. Could you explain those
So-
characterisations for
So the
us?
way we look at an issue is again sort of an isolation of all of the layers of control. If that happened, what would happen? So the issue rating is defined by the impact and likelihood. So for an issue, we say, on a matrix, here is this issue's impact if it were to happen, and here's its likelihood. And most of the issues in the home buying business end up being high.
Yes.
Because it's a big business.
Yes.
Even if it's a moderate likelihood, the impact would be large, so you end up with high. So it's not linked necessarily to the issue description in here. It's the overall issue that we're linking into here, and then we get into the detail underneath.
And if we go to that detail, we see that the third-party banking team have not confirmed if aggregators are meeting their responsibilities under the individual aggregator agreements. Third-party banking did not exercise their rights to audit until recently.
Yeah, that's right.
And why is that?
So that's what we were just referring to a second ago. When I took over the business middle of 2015, which I took accountability for the broking business, the business hadn't been doing these audits recently into whether the obligations of the contract we were talking about before have actually been being met,
Yes.
or whether indeed the compliance procedures that the head groups had were good ones. So.
So this is a recent development that this audit right is being exercised,
Yeah, that's
and so far it's only been exercised in relation to 3 head groups.
So, yes, this document in September, at this stage, I think we would have done 3, but as I mentioned before, Audit themselves had done 3 more with Bank West, and I think Audit had also been in at Aussie. So across the business, I believe we'd covered 7 at this stage, and when this had been done. I think that's right. I'm not exactly sure whether when this was written, whether we'd done 1. The timing's a bit, but that's how many we've done now, definitely. But certainly the time this document had been written, we'd only recently started to do those detailed audits, and before that we weren't doing them.
So could we look just at some of the specific examples of what's going wrong here?
Yeah.
The first being that there's a limited mechanism to confirm if the original customer identification information was cited by third parties. Do you see there that the audit group found 1,361 instances of where the borrower, the broker and the security property were in different states at the time of the application?
Yes.
And 332 where the borrower and the broker were in different countries at the time of the application?
Yes. Yep.
And 2,758 instances where the borrower and the broker are from different states. Now, those are pretty obvious anomalies in the documentation, are they not?
They, in this data analysis, they come out when you do that data analysis. We didn't at this time have that as a part of it, something that we were picking up out of the application process. I think the other thing that was here is, and we were talking about it before, our contracts haven't kept up with technology. So we refer in to face-to-face, which is what Audit's rightfully picked up here. They've said, well, some of your documents talk about face-to-face. We haven't updated those documents, so well, maybe someone's been talking on Skype or on FaceTime, so they may have met the obligation to have a personal conversation with the particular customer, but we can't tell it from this data, and that rightfully is what Audit's picked up and said, well, there's some data here which would suggest that face-to-face may not be happening. Now, there may be other reasons. It may be that at the time of application, someone was in a different country, but they may have had the interview with the customer before that person went away, or same in the state. But look, the point remains: our systems weren't set up to identify this, and
you weren't even looking into this.
No, we weren't. We weren't. I mean, it's a good observation by Audit, and it doesn't suggest that the loan is inappropriate for the customer, but it was a good finding by Audit, and we're building out something called the Command Centre, which is utilising that data, and is going to identify that in real time before the loans get funded, such that we can ask another question of the customer. So it's a good finding, and it's helped improve the practices.
It's a finding of a matter in respect of which the bank depended on what the broker told it.
Sorry, missed that.
The bank depended on what the broker told it.
That's right. We depended on the broker.
In many respects. In respect of house loan applications, the bank depends on what the broker tells it.
That's right.
Yeah, go on.
Well, another example of that is the second issue on the next page, Mr. Huggins, issue B. Broker discussions with customers on product suitability are not validated by retail banking services to confirm the product meets the customer's intended purpose and desired customer outcome. Management relies on brokers to confirm product offered to the customer was not unsuitable at the time of the application and for in-life changes. Now, under the National Credit Act, CBA is not permitted to rely on brokers to confirm that products are not unsuitable for the customer. CBA has its own statutory obligation to perform that assessment itself. Do you agree?
I mean, this isn't well worded. We absolutely assure ourselves of our own NCCP obligations and make sure that the loan which is provided to customers, as per the responsible lending obligations, meet the needs and objectives.
That's entirely inconsistent with what the audit group have found.
No, as I mentioned, I don't think it's well worded. I think what is
You say the audit group got it wrong, do you?
No, I think what they are.
Well, what are you telling me, Mr.
What I'm saying is we do not rely on the broker to do our assessments of the application and meet our responsible lending obligations. We will make those assessments based on primary documentation. But at this time, we were not going back to the customer and asking them to confirm, once we'd made that application, that everything we'd seen was accurate, and that would have been.
Go back to the customer and ask them anything.
So,
did you go back to the customer and ask them anything?
Not at this time. We do now, but at this time we were relying on the broker to provide an accurate application, and then for us, under our responsible lending obligations, to look at primary source documents to make that assessment.
You were very quick to tell me that you thought this part of the audit report was poorly worded. Do you want to reflect on that answer and think again about whether there's some poor wording here, or is it simply the fact that, at this time, the bank did not verify what the broker told it? It acted on what the broker told it. Now, that may be right, it may be wrong, but isn't that the fact?
Yes. Yep. The fact is that where it says management relies on brokers to confirm the product offered to the customer was not unsuitable. That is correct at that time. Yes. So I would correct the statement for that piece, and then obviously the other parts of us making our own inquiry would stand.
And could we just move to the second issue? There are many other limbs of this first issue that I won't take you to, Mr. Huggins, but the second issue is at 0008. this was the risk exposure issue, issue 1. Issue 2 is gaps in the monitoring process to prevent or detect adverse broker behaviour have not been addressed. You see that?
Yes. Yes.
And do you see in the first paragraph, third-party banking currently have 29 head groups with almost 13,000 active brokers submitting over 12,000 loan applications per month. Management do not have mechanisms and tools to proactively identify broker behaviours.
That's correct.
Does that remain the case?
No, as I mentioned before, we're building out the capabilities to identify specific broker behaviours on applications live. So we have some of those built, but we need to continue to build that out.
All right. There are other issues listed in this document, but could I just take you to the appendix, which is 0018. The appendix lists examples of adverse broker behaviours in connection with this particular issue that we've just referred to. Do you see there things such as the second observation, monthly living expenses less than household expenditure measure, 191,534 instances of that identified by the audit group?
Yeah, so this is where audit, these documents, if viewed without context, can or the understanding of the business can be misleading. And this certainly reads as though we've approved $191,000 less than him. That's not what happens. If someone were to, as is the case here for these loans, where someone has given monthly living expenses less than the household expenditure measure, then we ignore that information and we bring them up to the floor, which is the household expenditure measure. So what's that sort of assumed knowledge on the part of people that they would know that our system would bring that up to the floor.
Why do you do that? When someone declares their living expenses as less than him, why do you bring it up to him?
Well, because our experience is that customers, customers aren't that good at identifying their own household expenses, has been our experience. And therefore we set a minimum floor which must be applied in a loan that's linked to income and house size, to make sure that every loan that we approve has at least that floor. If a customer declares to us more than that amount, then we'll take the higher number, but people tend not to be very good at it.
So
and
you assume their expenses are greater or lower than they have told you?
Greater.
Greater.
Yeah. So we will always take the higher of the customer declared or him.
Yes.
So we'll always raise, and as you can see here, this says 75% are there. So a lot of customers are having it raised, and we ignore what the customer has told us where it's below our floor.
But what does that tell you about 191,000 customers declaring less than him?
Yeah, I mean it's a challenge that we're aware of, that customers aren't good at identifying it. So there's a range of work ongoing to try and improve that outcome. It's also worth. This is not the only. We're not talking about all customer expenditures. The way that the application works is we ask for other commitments, so other debts of the bank, and then other commitments, school fees and so on, and then this is the household living expenditure part. So it's an important part, but it is one part. It doesn't include other mortgages or all of those things are done separately.
Now, Mr. Huggins, there are 6 pages of examples in Appendix 1 of adverse broker behaviour.
Yes.
I'll just show you the next page so you can see the sorts of examples we have, but we see, for example, 83 instances identified by the audit group where a loan had been declined by a CBA branch and then accepted by another broker within a 6-month window. Is that a problem?
Well, it's a good observation that we should be looking at. It may not be a problem. The person may have applied for less money. They may have restructured the loan. So you don't know from this analysis as to whether it's a problem or not. But But it's a good thing to look at and to ask another question, and this was very helpful for us, and is something that we've taken from Audit. When they did it, it was new when they did it, and we've taken the way they were approaching this, and we are building that into the business as usual part of the business. So it was very helpful, someone coming in who's not close to the business and just asking these sorts of questions about, well, you know, you should ask a second question. It may be fine, but you know, have a normal process by which you ask the second question. So that's what we've gone and done and are building out.
All of these examples are referable to the second issue identified by the audit group, which was that there were gaps in the monitoring process to prevent or detect adverse broker behaviour such as these things.
Yeah, that's right. Yeah.
Yes.
Yeah.
I tender that document, Commissioner.
Exhibit 1.39, CBA 0508, 0001, issues log September 2017.
I have no further questions for
Yes,
Mr Huggins.
thank you. Is any party other than CBA who has leave to appear seek leave to cross-examine Mr Huggins? And do you have leave to appear, sir?
Commissioner, I actually applied this morning for leave to appear to examine.
Well,
I had no response, and I've
I'm not surprised because the applications for leave to appear were due in quite some time ago. First, what is your name?
James Martinek, Your Honour.
I'm just terribly sorry, sir. Could you spell your surname?
No, that's okay. Commissioner, it's actually Martinek. I did send through a very brief summary, and I've contacted the Commission over the last few days to have someone call me back. I'm sure that they're fairly busy. It literally is a series of 10 questions in regards to broking. And
Yes, and how are these matters that affect you directly, sir?
Your Honour, I've gone through a process that is current, and as of an email here, 6th of the 1st, 2017, from I think Mr Kusalak and Mr Cohen is the Chief Risk Officer for CBA, and it's really just in relation to one paragraph that was answered by Mr Kusalak, who is the Executive Legal Counsel for Banking and Technology, in regards to a broker that was an ex-banker that then became a broker. And it's a very simple series of questions. If Your Honour would be able to just take 5 minutes to have a look and see if it was suitable.
Have you written them down?
Yes.
The questions, perhaps if you'd be good enough to hand them up.
Yes. And all of these have been sent through. Your Honour.
Thank you very much.
I've got copies.
Just a moment. Mr Martinek, I've looked at the questions to CBA that you've, I'm sorry, there are 3 pages of them. I've looked at 2 of them, not the
I think
third.
it's really just the first 10, Your Honour, in regards to payment to
Yes.
family trusts and spouses.
We have already looked a little, and it may be that we will look a little further at questions about disclosure of commissions that are paid and to whom they are to be paid.
I suppose it is a current debate that's been going on with CBA.
I
And think if you look
understand.
at Paragraph 8 in
Yes.
particular, it negates nearly all of the answers that CBA have given.
What I think I'd suggest you do, Mr Martinek, if I may, is if I return these documents to you, what I suggest you do is you write down, and you should spend some time on this. I'm not suggesting you sort of go out the court door and write down in the next 10 minutes. I want you to take those papers, think about the issues that you raise, distill them, that is, refine them as far as you can. Now,
Yes.
not an easy task, but
No?
we've all had to do it. Then what I suggest you do is go onto the website of the Commission and put it in the form of a submission. Now, all of the submissions that are being made on the web are in fact being read. I need that to be well understood. I suspect I'm probably breaching everything if I say I will keep an eye out for yours when it goes through and have a look at it. But then I think we will decide what to do. So at the moment, the answer to your question, may you ask Mr Huggins questions, is no, you may not. What I suggest you do, by all means stay here for the balance of the day and as many days as you like, but go away, think about it, write it down, put it into the web form, and then leave us to decide what we'll do. Do you understand me?
Very much, Commissioner.
Thank you very much,
for your
Mr
time.
Martinek. Any other application for leave to cross-examine? Yes, Mr Sherry.
Thank you, Commissioner. Mr Huggins, what types of living expenses do customers typically underestimate?
Well, I mean, people tend to underestimate, how much they spend, going out, for dinner. They tend to forget, the maintenance that happens on the car once a year. So sort of infrequent things. They'll tend to do a better job with things that are more frequent. So grocery bills, for example, things that are always happening. People tend to do better, but in infrequent expense items tend to be, less well understood. We ask quite detailed questions, so things like expenditure on pets and some of those things. People may not naturally think about some of those things either, so they may not understand them.
Thank you.
You ask those questions anyway.
We break it down now into
Yes.
into 11 different categories, and
Despite that, people still come in underestimating, don't they?
yeah, they do.
Significantly underestimating.
It's hard to say. It's definitely under. The challenges with something like HEM is that you expect by the way it's created for some people to be below it. So it's certainly not as many.
Under HEM.
Yes,
Oh,
you do. We don't allow it, but the way HEM is created is you've got a basics. You take the survey which takes 50% of 50th percentile basics, so the median, and you add to that the 25th percentile of discretionary. So there will be some households who are below that level just because it's done on a survey basis and you've taken the median. So by definition, some people will be below it, but you wouldn't expect it to be
to be as
Very
much as it
modest
is.
lifestyle, according to the Melbourne
Oh, that's right.
group, is it not?
Yeah. Yep.
Yeah.
Mr Huggins, this morning you were asked questions about what would happen if the CBA were the first mover to go towards a fee for service as opposed to a commission basis. Do you recall that?
Yes.
And you said there'd be an issue about conflict. What did you mean by that, sir?
Well, you would create a conflict by doing that, which would mean that if you did have an existing CBA customer who likes the branch network, likes the app, range of reasons, and they say, I only want to go to CBA, the broker would be conflicted if CBA was on a flat fee and everyone else was on a commission structure today, that the broker would probably want to send them to someone else.
So the conflict would be the broker's conflict?
Yes.
And to what
And
extent
it's always the broker's conflict, isn't it? The conflict of interest with which we're concerned is only the broker's conflict, isn't it?
Yes, I think that's right.
A conflict between whatever duty it is that the broker owes to the client, query who the client is, and the interest the broker has, financial interest in maximising income.
That's right.
And but it's a different type of conflict, isn't it?
That conflict is a different conflict, yeah.
Yes, different to the existing one, which is what?
Well, the new conflict which is created is between brands, between different products. The existing conflict is one of loan size and pay down.
Yes.
The existing conflict is between the interest of the broker in maximising income and the duty the broker owes to the client.
That's right.
Is that right?
Yes, that's right.
And
Therefore,
the
it's the
flat
same
fee
conflict.
circumstance, the conflict is between the broker maximising income by going to an upfront and trail commission payer and whatever duty the broker owes to the client.
That's right.
Same conflict.
That's
Yes,
correct,
do
isn't
go
it,
on.
sir?
Yeah, that's right.
Plays out in different ways.
Same conflict.
Same conflict plays out in different ways. Do you
Yes.
accept that?
Yes, that's right.
In relation to the percentage or the proportion, I think you've called it, of business that home lending that you get, the CBA gets from brokers, what is that percentage?
It was 36% of new flow was coming through the broker channel.
Do you know
in the
how
last
that
6 months.
compares with other lenders, major lenders?
It's between 10 and 20% lower than other major lenders.
Percentage points or percent?
Percent. So other lenders are between 45 and 55% broker. So we are the lowest of the majors by 10 to 20 percentage points.
When you were being asked questions about switching to a fee for service with brokers, you mentioned something called unintended consequences. What
Yes.
did you mean by that?
So there's a few different areas which of that. So first is, and we spoke about it briefly, you may create other conflicts. So if you put a fee-for-service model in, and that was linked, for example, to loan complexity, so you had a fee-for-service for one loan complexity or another loan complexity, then it may encourage people to structure loans in more complex ways. So there's that. The second is that the other consideration, not a conflict, the other consideration is that brokers provide very good service to customers and to some segments of customers in particular, first home buyers, people with complex needs, and if you moved to a fee-for-service model, then you start to encourage people more to go towards volume than loan size. So therefore, some of those segments that are currently benefiting from the service provided by a broker may not be able to access those services going forward. And then, finally, you would need to make sure that broking remained a viable business for people, given that our research shows customers very much value that proposition, and there are some customers who are not willing or interested in going into our proprietary channels. They want to use a broker, and that's why we're in broker to help serve that segment of the customer base.
You said this morning that it is an objective of CBA to increase the proportion of loans to the proprietary channel compared with the third-party channel.
That's right.
But you also said to Ms Orr that decreditation won't assist that. Why is that?
Well, yeah, de-accreditation, what I meant in my comments this morning was de-accreditation was not going to deliver that outcome, so the complete outcome. And that was because the numbers we're talking about are relatively small. So the amount of volume that we're getting out of the 710 brokers that we de-accredit, or indeed the larger pool, were relatively small. So that would be insufficient to achieve, a large shift in the proportion of business coming through proprietary. I think the other thing, our goal, the strategy is to have a strong and sustainable broker network where we're not achieving a mix shift, that proportional shift, by just writing a whole lot less business in broking. That's not the way that we want to achieve that proportional shift. We want to grow whilst sustaining and being able to continue to service customers in the broker channel. We want to grow into the proprietary channel to deliver that mix shift. So it would be incorrect to say that the de-accreditation didn't help to some extent. If you went down that path, it would have helped a little bit, but it wasn't. It was not it would have been insufficient.
And finally, the Commissioner asked you about the polls. Remember the polls?
Yes.
The left was the customer outcomes and the right, or vice versa, was profitability. What constraints are there on the bank to go towards the profitability end of the spectrum?
Well, the constraints are that we need to run the business for the long term, and our focus is on ensuring that we're running the business and for the long term, and that requires customers to be satisfied with the bank and continue to maintain relationships with the bank. So we need to provide services to customers and experiences for customers which are very very good in a competitive marketplace, and therefore that provides a counterbalance to what you can do from a profit perspective. So you have to meet customer expectations. They are changing. There's a big focus on things like digital, and we have to spend a lot of money to keep up with customer expectations.
To what extent is the balance achieved by the competitive process?
Well, I mean, there's huge competitive pressure in this market. There's huge competitive pressure in home loans, which I can talk to most, and that means that you're restricted in how far you can move away from the competitive offering that is in market at that point in time. People have choice. It's a competitive marketplace, and whilst, as I mentioned earlier in my statement testimony, that there are some customers who will go to the brand that they've always been with, but that's a small number of customers, and what we tend to see is that customers have choice and they make those choices, and therefore if you are not delivering the right product and services and experiences for customers, then they have plenty of options to go somewhere else, and they do.
Thank you, Commissioner.
Just before you sit down, Mr.
Yes,
Sherry, you recall being taken by Ms Orr to the bank's submission to the Sedgwick inquiry?
Yes.
And can I act on the basis that what was said in that submission remains the position of the bank?
It's the belief of the bank, yes, as it's been written. I guess the only reason I hesitate in answering a question is, and as we've talked about, position would imply that I'm going to go into market tomorrow and apply that, and in that regard, it's not. But I don't think that's what you refer to.
No.
No. Okay.
Thank you.
Thank you, sir.
Anything arising out of that?
No, sir.
Thank you, Mr. Sherry. Ms
May
Orr,
the
is there
witness be
anything?
excused, Your Honour?
Yes. Thank you, Mr. Huggins. You're excused further attendance.
Thank you. You want some documents?
Ms Orr,
I've made.
wait until Mr Huggins.
Yes, I was going to suggest the next witness is associated with a different entity, with a different set of counsel, so perhaps if we could have a few minutes.
You'd better have until 3:05 so that council can order their books and papers and trolleys and etc. Thank you.
Commissioner.